Hi everybody, welcome to part 2 of the Wyckoff Foundation Primary Language of the Market, which is about bar by bar reading, and I've included a little bit of Wyckoff principles in here and a little bit of the Weiss wave and so on. So, oh, no screen, sorry. There, it's on the recording, but now everybody should see the screen. Did we send the recording of the previous class? It's been posted, I think, on the website. You need to log into the website to get it. We're going to send you out an email. It's either later today or tomorrow with some other information. We'll put that on there so that you make sure that you got access to both webinars at that point. All right, so let's get going here. Let's kick this through. Same story as last time, copyright and disclaimer. I don't think I need to review that again. All the charts here are from TradeStation. We don't need to review that either. By the way, I don't have any affiliation with TradeStation. It's just that I've been using it for a long time. I've used a lot of others. I've used eSignal. I've used TradeGuider. I've used Townsend Analytics, Metastock, AmiBroker. I've used a lot of different ones. Multi-charts, I think. I might have even looked at Ninja at one point. RT something. I forget what it is. They're all good in their own ways. It's just that I'm most used to TradeStation, and I've used that since 1999. In fact, was when I first bought TradeStation. Bought TradeStation 2000i, and so I have no interest other than that's what I use. I mean, I don't get commissions from them or anything else. They don't even know me, except that I'm a client of theirs. But that's it. So yeah, TradeStation is good. There's nothing wrong with TradeStation. Does everybody else have audio? Are you losing audio and then it's coming back on? One person says the audio dropped out. Sound is good and consistent. Okay, all right, good. Probably then your internet connection. We have a pretty good one here. We spend a lot of money on it, so it should be good. All right, so let's talk about what we're going to cover tonight. I sent out a PDF file of the slides, so you should have that in your email inbox. And so we're going to cover a slew of questions from folks who sent them in from the first session. And in the first session, we really talked about, how to kind of look at changes of trends. I mean, that was kind of the general theme there of session 1. So we're going to look at something a little bit different. We're going to look at trends a little bit more deeply, because that's the sweet spot in trading, right? We want to be in a trend if we can find one. And frankly, if you're trading intraday and you just watch, say, 3 markets, or maybe 4 at the most, you'll find a trend pretty much every day. I mean, there'll be some days where that won't happen, but pretty much every day. And the ones that I follow pretty regularly, I'm looking at oil. Well, certainly the S&Ps. That's my number one. And I'll trade that, and 90% of my trading is probably off of the S&Ps. But I'll look at crude oil. I'll look at the Japanese yen more and more. And then sometimes the British pound or the 10-year notes, U.S. Treasury notes. So, well, if you didn't, everybody should have gotten the slides. If you didn't get them, send an email to Helen, and she'll try to send you a set of them. I'm not going to stop now to do that. So we're going to look at trends. Also, we spent some time last time on accumulation, and covered that pretty well, at least in a fundamental or kind of basic way. And so I wanted to spend a little bit of time. Somebody mentioned this, Michael, I think you did, that we didn't really cover distribution. So I'm going to talk a little bit more about distribution today. Spend a section on it because that's worthwhile knowing and talking about. And then we're going to do a little bit more on the Weiss wave, especially with respect to trending. And then I'll show you a couple of advanced ideas on the Weiss wave as well. Not a lot on the Weiss wave because not everybody has it, but I will spend a little bit of time on that. And then I think what is the most important thing that I can talk to you about is how to do applications in multiple time frames. In fact, some of the questions that came in was very clear to me that people are not looking at multiple time frames, and you really need to do that. And I'll give you sort of an introduction to that. And then we'll continue to emphasize some of the things, or most of the things that were covered in session 1. Okay? All right. Hopefully that sounds good to everyone. I think the combination of the material we covered last time and the material we're about to cover today, along with some of the questions that people asked, I think you'll have a pretty comprehensive view of how to read a chart, on a bar-by-bar type basis, and also a little bit about the Weiss wave. You'll have a pretty good understanding of what to do. And then at the very end, I'll discuss some things that you can do next step. But also, some next steps. Let me also say this, though, that even though this is all good material, there's no question about that, and it's all current stuff. It's over, it's almost 15 years worth of my work in this area. So it's I think it's very good material. So even though it's very good material, and even though you watch the video, or even if you watch the video a couple of times, you take notes and so on and so forth, it's not going to be enough. I can tell you that right off. This is not easy to do, and rightfully so. I mean, think about it for a second. We're watching the Australian tennis championships now, the Australian Open, and there's 148 people that get to play in the tournament for 2 weeks and see if they can how far they can get in the tournament. But there's probably millions and millions of tennis players across the globe, right? And all these Grand Slam events, what we call the Grand Slam events, like the Australian Open, Wimbledon, which occurs in England, the French Open in Paris, and the U.S. Open in New York. Those are the 4 majors, and there's only 100 and just round it off, 150 people that get to play in that. And then there's only a couple of dozen, maybe 25 people who really make decent money at it, the top 25, top 50 players in the world. And yet there's probably millions of people across the globe who play tennis. But most people will say, gee, I'd like to play tennis, and they go out and they buy a pair of tennis shorts and a pair of tennis shoes and get a t-shirt and buy a racket and a couple of cans of balls. And that's basically it. They don't do anything else. And they might play, a little bit, but a year or two later they probably aren't playing at all. They don't put any effort into it. Other folks who want to play well would take lessons and practice and play a few times a week. And they're the ones who are and they play tournaments, in regional tournaments and stuff, and they've got some competency with the game. And they can play it reasonably well. But there's only a few of those folks. I mean, it may seem like there's a lot if you go to a tennis club and you see 20 or 30 people who are in that category. But compared to all the rest of the people who play, there's not a lot of them, right? And then if you get on to the professional level, and especially at the Grand Slam type level, which is really sort of the Olympics of tennis, you're really only looking at a handful of people. So what I'm trying to say is that, if you just view the video, you're kind of like we call in tennis we call them hackers, who just kind of play and don't play very well and hit most of their balls out of the court rather than in the court, and don't really get much out of the game and don't put much into the game. you don't want to, if you want to learn how to trade and make money, you don't want to do that. That I can guarantee. You don't want to take this casually or lackadaisically. You've got to be serious about it. You have to put in the effort to at least get yourself up to a level where you're competent in reading the charts and making trades and managing the trades. And that takes a lot of work. It's a lot of practice, a lot of study. And so I got off on that soapbox, and I apologize for that, but it's important. This is not easy to do, and you're not going to be able to get it right off. And you have to put the time and the effort in. So, all right. Paul says there's a process to everything of study and practice, and absolutely right. Absolutely right. Okay, so here's some. We're going to start off with the questions from folks, because I think that's always a good spot to start. And they're trading one of the American stocks here. It's called Facebook. And everybody, I'm sure, is familiar with Facebook. And there's a lot of kind of small type in here, so I retyped the basic gist of it. He says, this looks like stopping volume here, in here somewhere. And then he says, I think it's a he, it might be a she, I forget. Says, I went long here on what I thought was a spring, but it didn't work out. How come? Well, let me show you what I think about this. What I see here is this. I see that we had ease of movement coming down off of this chart, right? Remember we talked about ease of movement before? I see volume, pretty good here, sustained coming down, and so we put in a low. Now, I look at the next rally, and look at that volume. There's not really any volume to it. And we could put a trend channel in here, and it gets oversold, and all that stuff. And so we put in a lower high. And then we take that low out. So this is my definition of a trend, of a downtrend. We are in a downtrend, okay? Then the next day, I'm assuming this is the next day here, we gap open. Well, boy, that would sure widen my eyes. We've got a downtrend in the offing, and now I've got a gap down. I don't know what the daily looks like on this. It'd be interesting to see what the daily chart looked like, and we're going to talk about multiple time frames a little bit. So we'll cover that a little bit later. But my guess is that this did not look. If I were to think about how did this day here look on the daily chart, I would kind of probably look at it like this. It closed here, and it was this kind of a big bar down. Okay, so to me, and then the next day, I think it ends here. We got another gap down here too. I didn't even see that before, but the next day is a narrow range day, or a narrower range day, and it looks like this. That's closing here. And then we gap down, and what I see here is that even though this looks like an up day, there's really no ability to rally, and most importantly, no sign of strength in here. I don't see any indication that there was buying. If this was stopping volume, and I don't think about stopping volume when there's a gap, but you can, I suppose. If this really and truly was stopping volume, and by the way, it would be over here. This, if it were stopping volume, this would be the stopping volume here. If it really and truly were stopping volume, then we would have, you have a little rally here, you come back, there's volume is kind of drying up. Well, then you should have seen this volume start to come in here. But we don't see that. I don't see any indication of strength. So buying the spring is, and this is an awful lot of volume coming into, we're going to talk about that tonight too, coming into a support level. You don't want to see that kind of volume coming in, and you want to see less volume coming in. And it's basically the same amount of volume that you had coming in over here. So what that says to me is that whatever supply existed over here, there's a very similar amount in here. And yeah, there's a spring because this is yesterday's low, and it's not a surprise that it would do that. But then what do I get here? Volume's going down. That doesn't look good to me. And then it comes down here. I'm not sure which is the volume here because I didn't go back and count this. I don't know if this is a pickup in volume or not. Probably not. But regardless, this is what we call hugging the lows. We're not getting any lift off. A spring should lift. You know, let me erase this a second. I'm not going to go into great detail on the spring because it's really a trade setup. But this could be considered a test of the spring. Well, once it tests, it needs to go. Okay, once it tests, it needs to light up and go. And if it doesn't, if all it does is roll over like this, that's a very bad sign, and that is telling you get out right now. Okay, so really you got a downtrend that starts off with good supply coming in. It continues with a big gap down. We have 2 days of down, so it's not a surprise to see some sideways movement. And then we get more ease of movement coming in the next morning into yesterday's low, and then you've got lower lows and lower highs all the way across the board, and then this is just not working out. You don't want to be buying springs. Look, let me put it this way. If you haven't traded springs a lot and you're not intimately familiar with them, then my suggestion is you don't trade them in a downtrend, especially if a downtrend is just getting underway. And I can't really tell from this chart if this is just getting underway or if it's been going on for a while or what. You really don't want to be just springs in a downtrend they don't have the same odds as other springs do. So I would encourage you not to trade them when there's downtrending conditions, and look instead for springs and uptrends, springs where there's clear signs of strength in the background, and the like. Okay, but a good chart for all of us to learn from, because it's not as it's easy to make a mistake. You don't want to. Here's the other thing too to think about. And this Wyckoff was very, at the time that Wyckoff was writing in the from 1910 to early 1930s. He died, I think, in 34. So he was very active with the Magazine on Wall Street and the Ticker. Those were two magazines that he was writing, and they were incredibly popular with both brokers and clientele. He had to actually limit the number of subscriptions that he was giving out, but then it didn't matter anyway because brokers would buy them and then give copies to their clientele and make recommendations based off of Wyckoff's work to their clientele, and he would actually move markets in his day. It may not be possible these days because of the huge volume, but he was writing all the time. He was studying all the time, and one of the things that he was very clear about was patterns like flags and pennants and even springs and upthrusts. Patterns are not what are traded. What's traded is what the market is telling us. We use springs and we use upthrusts as a sort of a quick and dirty way to identify something, but we never want to take a trade just because it's a pattern there. We want to go back into the background and look at it and make sure we've got a good set of reasons for taking the trade, not just because it goes underneath support and then closes above it. That's not a good enough reason. That's like trading candlesticks. It's just patterns. And I was going to say Schaubacher, Richard Schaubacher, I think his name was Richard, was writing at the same time, and he was the one who categorized all these patterns. He categorized flags and head and shoulders and reverse head and shoulders and pennants and all of that stuff. And he and Wyckoff were at odds with one another because Wyckoff, was very adamant that if you're going to trade patterns, you're going to get hurt. Because he saw it, and he operated a brokerage company for many years and saw people come in and trade. Well, that's a flag, or that's a pennant, or that's a Head and Shoulders. I remember in 2010, people were saying it's a reverse. It's a Head and Shoulders pattern. We're going to go down and take out the 2009 lows. Maybe it was in late 2009. We're going to go down and take out the year's lows, and we're going lower. It's going to be a disaster. And I wrote an article that was published on, what was it published on? Someplace. And I said, that's not a Head and Shoulders. This is a spring in an uptrend, and we're about to go much, much higher. And of course we did. The spring was a good trade. Okay, so let's see. A question or two has come in. Try to keep your comments a little briefer, please. They're hard to read. Like your tennis analogies, sounds like you know your stuff. Another analogy might be that there are no qualifying draws, no JV teams, no ladders, no age group. We're being thrown into the main open draw with a real pro every time we enter a trade. Yeah, I mean that's actually not a bad analogy. I played club level tennis, and I'm okay at it. I'm not great, but I'm okay. And at my level, I can hold my own. But if suddenly I got a wild card invitation to go to Wimbledon, I mean, that would just be ridiculous. I would have no chance playing even the lowest ranked player at Wimbledon or the Australian Open. It would be a joke, because I haven't trained at that level. No athlete, no professional athlete would dare think twice would ever dare to step on the court or on the playing field without an awful lot of practice. No psychologist would dare make a diagnosis of someone in a clinical patient without having gone through a lot of study and a lot of practical applications of psychology. Same thing with a physician. Same thing with a lawyer. They wouldn't try a case without having, read the law in school and practiced for a number of years. Trading is so easy to enter. We just think it's not a big deal to put an account up and go in there and go play. And Wyckoff in Studies in Tape Reading talked about that and said he called them lambs. The people who put their money up and immediately want to jump in, they're lambs waiting to be sheared, because Wall Street is a tough place, and it's true. Okay. No worries about the interruptions, Bill. That's okay. I just saw that as long, and I thought, oh my goodness. It seems the pros want you to see a pattern. Sure, they would love for you to see a pattern because they are playing. They know your emotions. They know that you get whipsawed so easily, and they're in there. They have to know that. They have to take your contracts, right? If they're selling, if they want to sell a contract, they want to bid it up so that you buy it, and they have somebody to sell it to. And that's the way they get short, because they're trading in large amounts. Look at all the volume, here. Look at all that volume. That's coming in from, all over the place. Okay, what are these bars? I hesitate to go shorter to add to a position. Well, it's hard to read this chart, but this is the noon hour. And that's typical, somewhere between 12 and 2 o'clock in the afternoon. Eastern time, the markets kind of go dead. And also, look at the huge move down. 10 minutes, this thing dropped, however many points it dropped. And then there was some typical movement back and forth, and then this is not unusual. It just drifts and drifts and drifts down. My suggestion: trade other markets than this. This is not a good market to trade when it does stuff like this. I would look for more actively traded stocks. And stocks do this all the time anyway. They're not like commodities. They have a tendency to do this and trade on maybe a higher time frame instead of 5 minutes. 5 minutes for a stock is really tough, at least 15. What's the percentage of trades that you make are successful and percentage of losses? It depends, Marilyn, on the trade setup. But in general, I probably got about 70 to maybe 73 or 5% of winning trades and about 30% losers, give or take. And that's true for about everybody. When it's a trending condition, that will go up probably above 80%, probably into the mid 80s, maybe the high 80s if I've got good volatility and good trading conditions. Then my trades usually go up higher. The thing I always struggle with is I'm looking for the market to turn, and I'll try to get in, and then usually what I do is if I trade in multiple contracts, so I'm trying to get in at a low point, and I usually am too early when I do this, and it's something that I always struggled with for a long time and still do. But at least now I only put on 1 or 2 contracts instead of a bunch, and then I don't. It's not a big deal to get knocked out like that. But that's, I mean, if there's one thing that I need to focus on, that's the thing that I need to focus on more. Like yesterday, yesterday was pretty straightforward trending. The day before was Thursday was more like that. If you look on the if you use the Weiss wave, you look on the charts, Thursday was less clear to me than yesterday. Yesterday was just one heck of that did a lot of damage to the market. And we were looking at that in deep practice. Okay, this fellow has some questions. Let me change the pen color so we can see here on the black background. He's talking about bar A here. It's got low volume. So why does the market not go down with bar A on low volume? It's an up bar with low volume. Shouldn't that be no demand, basically? And then why isn't the next bar, B, a down bar? Well, there's a number of reasons for that, but the basic ones are this. Look at the nice ease of movement going up here, right? Nice ease of movement going up. It's pushing up, and you've got this resistance up here, and it closes right on the resistance. So what is markets can go up on light volume. And this is, what is this? The Australian dollar. Yeah, markets go up on light volume all the time. The background conditions on this are that you had a low put in here, some shortening of the thrust. The market does not go down any lower. It pops off of this, and it's, the target is to get up above here. So just because this is, and you had a bar here that closed on its low prior to that and lower volume, it kind of tested there a little bit and then just continued to go up. Markets can rise. You have to find spots. You can't just pick a bar out like this in the middle and say, okay, well, it's low volume. How come the next bar doesn't go down? That's not the way to do this. You have to look at the background and say, where's the supply? Where's the supply? Okay, same thing up here. Bar C is this. It's down and it has low volume. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. It's this volume here. Okay. So it's a down bar on low volume. How come it didn't stop? Why does the market keep going down? Why is bar D not up? Well, here you've got supply. Look at this. Look at that bar. You go up above the previous bar and you come down, close it below the low, and we just start slipping down. this is supply coming into the market. You don't want to be trying to buy into that. You have to be looking at things that are going on here in the market. You have to be looking at the background conditions. You cannot just take an isolated bar or two and try to make a distinction and try to read a whole market based on one bar and one volume, or 2 bars and 2 volumes. That just doesn't happen. Same thing here. Why doesn't bar 2 go up? Here's bar 1, and then the next bar. Here is bar 2. Well, you don't have any strength in the background. You're just going sideways here. You can take, remember in the free webinar, I think I said you can just take a ruler or a line here and draw a straight line through, and these bars will be going back and forth through that line. You can't do that here. You can't do that. You can do it a little bit here because it's congestion, but you can't do it here. So in congestion, that's what happens. And so this is just congestion. We've gone down quite a ways. We're just going sideways. And then what we look for is exactly this to go short, not for the market to go up. Because why? Because we're in a big downtrend here. We've been in a downtrend for, I don't know, what is this? A month, I guess, right? So half, 1, 2 and a half, for 3 months we've been in a downtrend. So 1 bar isn't going to change that. Right? We'd be looking for this thing to close back underneath resistance, and that's where you go short, right there. That's what we call an upthrust. So again, it requires a lot of study to begin to integrate this stuff. It's not easy to do. Okay? Yeah, Rama says the key is context and structure, and the context here is coming down, and the structure is sideways trading range. There's no demand that showed up in here. Haven't seen any demand in here. Okay. Okay, so here, let me change the pen color again so we can see. All right, here this person's trading the Aussie Japanese yen cross rate. I don't know if this is the Forex or, yeah, it must be the Forex. And so she's using tick volume in here, which is fine. So she says, I went long on the spring bar, and she's got a yellow marker here. But after several bars, price reverses for one more swing down. This happens all the time. Well, okay. What I would say, first of all, is that this is not a spring. A spring needs to go underneath the last swing low. This was the last swing low here. Needs to go underneath this and then close above the that swing low. Okay, so that's a spring, and this isn't a spring. So that's one thing. The other thing is that when I look at this, what I see here is probable climactic action, and we just go sideways and we start coming down. We've got ease of movement down. I don't see strength coming in. It's not really a spring. And you can kind of, you can see, even though these are candlesticks, you can see that we're going to talk about distribution. They're selling in all of these bars in here with the, what do they call it? The wick, I guess, up there. And then, if you drew a line across, whoops, sorry. If you drew a line across here, you have an upthrust situation. And you've been making lower low, lower high, lower low, off of this high, off of a probable climax. So I don't see anything that's going to turn this around. Yes, you're on top of support. That's the one thing you got going for you. So you can take this trade thinking, okay, and this is a 15-minute chart, so you could do that. You could take this trade, but seeing all of this negativity coming in, and then the thing up thrusts. I mean, right here on this little, what's the term for this? Spinning top. See, I know candlesticks. Isn't that supposed to mean it's going to go up? Silly ass things. Anyway, I would be out on that bar right there as it closes underneath this line. You don't want to wait for this, especially, and then you see this ease of movement coming down. So you see this, you got to get out don't get out down here. If you set your stop down here because you bought on this, right? And you see, you're not able to read this, but you see this. Well, get out now, even though this loss here, assuming you got in here, this loss is a whole lot better than this loss. Okay? Professional traders will cut their losing trades quickly. I scratch out a lot of trades. I cut trades quickly if I'm wrong. So you want to do that. Paul says, this is good seeing what others are thinking. Yeah. And Tong says it's a corrective ABC. Well, we're not. You're right, Tong. It is. It's an ABC up, but I'm not going to go into that in this because there's just too much information. But good observation there. Is there something that indicates possible climactic action up versus ease of movement? Yeah. When it goes vertical like this, you're going boom, almost straight up. A good trend. Here's good ease of movement up. A good trend is a 45-degree angle, okay? 45 degrees. So if you drew your line like this, you drew your chart line like this, and you did this, 45-degree angle, it cuts it more or less in half. That's a nice angle. Well, if we did that here, this is 45 degrees. This is probably, 75, 80 degrees. That's too fast. That's climax. And look at all the volume. It's bigger than any of the volume you got up in here. It doesn't all come in on one bar, but you got, a bunch of bars like this. And then, as we're coming down here, look at the volume comes in to the downside. That's not a good sign. And as we rally up here, no volume comes in. As we rally up here, not much volume. You got volume coming in here, but it's at the top of this. If we drew that thing over here, it's not going anywhere. This is effort to go up without any result. So you want to get out of that trade. It's not a mistake to get out of a trade. By the time the spring came, there was too much damage done. That's right, Edmund. Absolutely right. Okay, here's another question. Prices always seems to go one leg further up or down and then moves in the same direction I intended. Then later moves in the same direction I intended. Yeah, so you're getting in too late. So price forms a higher high again. High of the day for yesterday. Let's look at this chart. And this is good because we can all learn from this. Here's yesterday's high. Okay? So if you're a day trader, you always want to know yesterday's high and low, and any nearby high or low. Okay, I don't know. Say we're in sort of here's yesterday's low here, but right near it is like the 2-day low. So you want to know that too. Okay, yesterday's high. In this situation, I'd want to know yesterday's high, yesterday's low, and the 2-day low because it's so close. Okay? All right, so anyway, so yesterday's high. Well, what happens here? It rejected yesterday's high. Selling came in here. Here's the way to think about this. If you're a day trader, it's really important. This is where sellers came in and had an effect on the market yesterday. Okay? They stopped the market from going up at yesterday's high. So today we come up And look at the volume. Yeah, it's going up. That's nice, but compare it to what we saw over here. It's less by a bit, right? And then you get this, what do they call this? A dangle-legged doji or a graveyard doji or something like that. But if we were to just look at this, we would see this closing in the middle. That's not an indication that this is a strong market. And so it comes down, and then we have no demand here on the low volume, whichever bar it is, I don't know, but it's fairly low volume in here. And then the market comes down, and look at what happens. It builds volume on the way down. There's strong volume coming in on the way down. This is not a place to make a trade long. You wait, and then on the rally up, you've got light volume, and you make your trade there. There's where you short. You want to go short here, not long. Okay? You want to go short, not long. When a market upthrusts yesterday's high, it means that it's going to most likely go down and try to test down lower. It doesn't go all the way down. Maybe this was yesterday's low, I don't know, but it doesn't go all the way down to yesterday's low. But the nice trade there was to go short here, not be trying to buy into weakness in the background. If you're right near yesterday's high and it gets rejected, it's not the time to go long. You're looking for a short trade. Okay. Same thing on the reverse. If we were down near yesterday's low and it springs off of yesterday's low, there's the spot to go long. Not try to short that a little bit later. Hope that helps. Do you look at the Globex high and low with less value than yesterday's high and low? Yes. And these days, I don't even think too much of the Globex high and low now. I'll note it if it's there on the chart, if it's an obvious spot. But it's not the same as yesterday's high and low. And yesterday's high and low, I think now include the Globex session. Is there a specific time frame springs or upthrusts work better than others? Because if I just change time frames, that spring or upthrust might not be there. Right. If you bump this up into this is 10-minute time frame, so if you were on a 30-minute chart or an hourly chart, you would not see this. This as a spring here, right? But springs will work on any time frame. Everything that I'm showing you works on all time frames. That being said, you don't want to go down too low. For example, 1-minute charts are really a joke. Tom Williams always used to say that, or says that trading off of a 1-minute chart is like fighting in World War I. You got poor equipment, and every time you stick your head out of the trench, you get picked off. And what he means by that is that on a 1-minute chart, there's setups all over the place. You see all kinds of stuff, but they're so tiny that you can barely get in and turn around in them before they're going in the opposite direction and stop you out. So, this happened to me. I always thought that the smaller the time frame, the less the risk, and the more I'm going to see, and the better I'm going to be at the trading, and so on and so forth. Well, the truth of the matter is, the smaller the time frame, the more you're going to see, and the more confused you're going to become. And it happened to me. It happened even to David Weiss years ago, and it happened, when I was mentoring individuals. They would all. I knew they wouldn't even give up the 1-minute chart, but they were all using 1-minute charts to start off with. And the ones that finally did give up 1-minute chart and went to at least a 5-minute chart or a tick chart, they started to turn their trading around and do better. So, but here this person's okay on a 10-minute chart. This is fine. And plus, you can't see the big picture. Well, you may not be able to see the big picture on a 5 or 10-minute chart either. You need to look at multiple time frames. We're going to talk about that tonight. What's the lowest time frame I use to manage my chart? I use a 3,000 tick chart, which kind of varies, and I'm going to bump that up pretty soon, probably to 4,000 or 5,000, because it's getting too too ragged, too erratic. It's acting too much like maybe a 3-minute chart at this point. So I'll probably push it up to 4,000 or 5,000 ticks. But I use that, and I use a 15-minute chart for day trading, and then an hourly and a 240. Yeah, that would be the S&P futures. In the yen, 750 ticks, and then a 15-minute. And in the and that would be for the same for the cross rates, the like the Aussie to yen or the dollar to the pound. The pound would be about 500 to 752 as well. The Aussie dollar, I think 500 was what I was using there. So just look for TY, yeah, 750 to 1,000. 750 to 1,000. Look at it and just see what's pleasing to your eye. Okay, here was a question from somebody. It didn't really deal with charts, but more about trading and making money. So I debated on whether I put this in, but I thought I would. He says, you mentioned 3 to 4 points on the S&Ps as an achievable daily average for intraday trading. And I think, yes, that's absolutely right. If you trade 3 or so days a week, 10 points a week, and 40 weeks a year, this would equate to around 400 points in a year, at least. That's right. Of course, it takes years and much effort to get to this level, and that's probably his best comment here, or his most important comment. So I'm going to highlight that for everybody, and maybe I can even use the highlighter. Let's see. Yes, I can. Okay. It takes practice. I don't know that it takes years to get to that level, but it certainly takes practice. Let's put it that way. So, but if I'm reading into this correctly, it's an achievable target that other professional traders accomplish. I also understand it comes down to what you believe in yourself. No, it comes down to practice. And I don't mean to get harsh on this person, but just I'm saying this to everybody else. This is not really all that important. What's important is that you learn how to read the charts, and you know that you can read the charts. Your confidence is going to come through the development of your skills, not what you believe. I can believe I'm a banana, for God's sakes, but does that make me a banana? No. And I can believe that I'm a good trader, and I know how I can read the charts, and I can, affirmations, for example, just to do a quick little bit of psychology, like every day I'm getting better and better in every way. That's nonsense. In fact, it has just the opposite effect for people who tend to be more depressive. If somebody who's on the depressed side of things says affirmations, positive affirmations like that, they become more depressed and more unskilled because they're not doing the work. Forget about belief in this way. Focus on practice and developing skills. That's the correct assumption, is developing your skills. Then you can get to this point on a daily basis. All right, so anyway, that's my soapbox. And so with a $10,000 account per contract, this is a 200% return on investment per annum. That's phenomenal. Well, that's pretty low, actually. Let me show you what really can be done with this. So we're going to do this as an account at $10,000, okay? And I hesitated to do this, but I'm taking this as a serious request, and I believe it's a serious request. So I want to give a serious answer to it. And this is how you need to think about your trading. If you want to be a professional trader, this is exactly how you want to think about it. So I said the other day you can earn 3 to 4 points a week, and once you develop skills in this, and that is absolutely right. So let's assume you're going to look for 3 to 4 points a week with 1 losing day per week. Okay, so 4 out of 5 days you win 3 points or 4 points, and 1 out of 5 days a week you're going to lose 3 or 4 points. So instead of making 3 times 5, 15, you're going to make 12. Well, they're down here, 12, and instead of 4 times 5 for 20, you'll earn 16 points. All right, but I'll get to that in a minute. Let's keep going through the assumptions first. All right. Risk. You always, 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 and always keep it at 2% or less. Okay? I see people have a $10,000 account and they're putting on 15 contracts or 10 contracts if their margin lets them, if their broker lets them. That's nuts. That's crazy. The reason you keep it down below 2% is because you can have a string of losses, which you will on occasion, and 4 or 5, 6 in a row, and you won't damage your account to the point where you can't recover. Okay? You want to be trading smart, not making a ton of money all at once. So always keep the risk down below 2%. And patience has to be considered a virtue in this. Patience has to be something you aspire to and strive for, meaning you sit on your hands most of the time. It's not easy to do. Few people can do it. Okay? Second, points per day. I'm sorry. That's right. Points per day. Somebody made that point. So second assumption should be points per day, not points per week. So earn 3 to 4 points per day with 1 losing day per week. Patience is the biggest battle. That's right. Okay, so let's take a look at this. We start off with one contract. We're starting off with a $10,000 account. Okay, that's our account size. We're starting off with 10,000. And to keep our risk below 2%, we'll risk on any given trade. This is theoretical now, okay? Sometimes we're going to risk a little bit more. Sometimes we're going to be able to risk a little bit less. But an S&P point is worth $50 US, okay? So if we risk 3 points on average per trade, and we're trading one contract, that's $150 risk per trade that we're making against our $10,000 account. So if we lose the trade, if we lose on that trade, we lost $150. That's not so big a deal, right? If you put 5 or 10 contracts on and you lose $3,000 on one trade, you're up the proverbial creek without feasible means of locomotion, somebody said to me. In other words, you're up shit creek without a paddle. And you don't want to be there when you're trading because that damages your psychology, it damages all kinds of stuff. So you keep your risk below 2%. So if we risk 3 points, $150 on one contract, we're risking 1.5% of our account on each trade. Okay, so if we go for 3 points a week, and we have 1 losing day a week, 3 points a day, we have 1 losing day a week, then that should be an average. Some weeks you're going to get a little bit less, some you're going to get more, but you should average around 12. And on the high side at 4 points, it would be about 16 with 1 losing day a week. Everybody follow me so far? Let me see yes and no's. Okay, good. All right. So this is what you don't think about, is how much money you're making. What you want to focus on is how many points you're making. Okay, but I know money is there, so it's not going to. So you're going to make 600 on the low side to 800 on average per week on the high side. Okay. So you do this for 10 weeks. And at the end of the 10-week period, you've got your original 10,000 plus what you've earned. 10 times 6 is 600, 10 times 8 is 800. So your account is now grown to 16,000 or 18,000. Okay? That allows you to put on another contract. And your risk at 3 points is still under 2%. And you do this for 6 weeks. Now you're making $1,200 to $1,600 a week. And at the end of 6 weeks, you're somewhere between 23 and 25,000 in your account. Okay? That allows you to go up and bump it to another contract. Notice what you're doing. You're starting off relatively small, and you're earning the right to add contracts, to add position size. You're earning the right, and the way you track it is your account size. Your account size versus your risk point. Okay. So now you're at 3 contracts. Same thing. Now you're up around $2,000 a week in terms of gain. At the end of 6 weeks, you're between 34 and 37,000, and on it goes. But by the end of the year, assuming there's 52 weeks in a year, and you're going to take a month off for vacation, 48 weeks, you can build yourself up to 10 contracts. And notice your risk is going down as you do this. You can probably add a couple of other contracts in there, right? And you're now making somewhere between $6,000 and $8,000 a week, which on a per annum basis is going to be well north of $350 a year. And that's going to be a whole lot more than return on investment. I never think of return on investment. What I think about is, can I make an average of 3 or 4 points a day with 1 day a week on average that I'm losing? And can I do that consistently? Can I make the mindset such that I can do that consistently? And as I prove to myself that I can do it consistently, I can add to the position size. I'm not changing anything else in this series of equations. All I'm doing is adding position size. I'm just continuing to bang out trades that I know are good or have a good chance of winning. And as I do, I can build my account size up. I can build my equity curve. And as I build the equity curve, there comes a point, and it's roughly six weeks up until this point, and then we get a break here. Every month I can add a contract, and within a year I can be trading pretty decent size. Okay, everybody see that? Everybody get the idea here? I think it's hard. It's harder to trade one contract as 2 or 3. Well, you don't think about it in those terms. You think about it in these terms here. If I have 5 losses in a row, I still have $9,000 in the account. I can make that up. What other instruments can you apply this analysis to? For instance, options on stocks. You don't trade if you don't trade the S&Ps. Yeah, you can. I'd have to think through how to do it on options, because it's, you'd have to have a dollar risk point. So if you're trading options and stock equities, you're going to have a lot more money in your account. I think probably minimum is around 25,000. So you probably need more money than that, to do this. But you'd have a minimum amount of risk in there. Maybe $500 is your stop point, your dollar stop. So any trade you make, you can't have more than a $500 stop on a $25,000 account, and hopefully it would be less than that. It's more like around 400 or 375, something like that. So you might only be able, instead of contracts, you're now looking at, in terms of equities, maybe 100 shares here. Okay, and it's going to depend. Doing the equities is going to open up a whole bunch of variables, but the price of the stock is going to, make a difference too. So it's really not contracts; it's going to be position size. So I'm not good enough in math to be able to figure that out, but it might be, $4,000 position size is what you would be doing, with a risk of $300 or $350, right? That would be like 1.5% of 25,000 on a $25,000 account. Anyway, you have to figure it out, but the basics are there. You can apply this on any system or any instrument. Starting with something like YM, as it's good to lower the value per point. You can certainly do that, Moby, absolutely. The point you just made is brilliant and worth many times the price of the webinar. Thanks, Rama. Back to the subject. Yeah, let's get back to it. Okay. David says, thanks for sharing, helps and gives mental support for those who are just learning to trade. Yeah, this is money management, and part of money management is position management, position size. Okay? All right, here the person says, I struggle with exits and would love some guidance on how to use bar by bar to manage exits. The simple answer to that is to look at the higher time frame for support and resistance and use those as targets. So if you're trading off of a 5-minute chart, look at your hourly chart and see where resistance lies overhead, and try to and have that as a target. And then you manage it by using your assessment bar by bar to see if the price is moving closer in the right way towards that target or if it's not. Okay? I mean, that's the simple answer to it. So, for example, if I were taking, I'm just going to make this up here, if I were taking a trade here, I might look to see, first of all, can it clear this? And if it can clear this, then it would go to here. It doesn't look like it quite makes it up to this level. It does clear that, and then, you know, my stop would be right at this point, at this here. And I would I'd move my stop up and I'd see if I couldn't get it up to here. But at this point where it starts to turn down, or even in here where I get 2 bars in a row of negativity, then I would look to maybe get out of that trade. All right, so I forget now, what was this? I entered this spring after a low volume test and I got stopped out here. So he entered the spring here and he got stopped out here because of slippage in fast market. That's amazing to me that you would get slipped that much. What is this? The Aussie dollar. Boy, that doesn't sound right to me. You shouldn't get slipped like that. Anyway, how come this didn't work out? What I see here is we are in a downtrend, but you did have a nice push up here. It looked like buying came in. Then as we came down, volume got really low to the downside, and you took this trade. To me, this looked okay. What didn't look okay was this bar here. As soon as that occurred, and you had ample time to get out without getting slipped so much, as soon as that negativity occurred, I would have been out of that trade. I would have just pressed the market sell order button immediately. In fact, before this even closed, what do you, 200 tick bars. This is too small of a chart. I know some people use, and I know David even uses a small tick chart, but if you're not like, you know, he's got 45 years of experience trading. It's different for him. Get up to a higher time frame. Don't be doing these small things like this. This could just be a 15-minute leg down for all I know. Maybe not. It's not quite that, but I'd go to a higher time frame. This is too small to trade off of really effectively. Anyway, this would tell me to get out of the market right away and to exit out. And this thing did rally a little bit. You can see it on the next bar, so you shouldn't have had such a slippage problem with that. Okay, let's keep going because we're for 15 minutes. What's the higher time frame we should look at? Asked Linda. The hourly is good. The hourly, and just, you know, look on your charts. There may be something before the hourly that comes up. So, you know, it's painted in the last hour. You have to look at multiple time frames. I'll show you a little bit of that tonight. Without a lot of warning, price has fallen hard in the last 2 sessions. There doesn't appear to be too much weakness in the price bars over the last 2 to 3 weeks. On reflection, price has lost a little stride over the last 2 months. What he means is that we made good progress up here, didn't make such good progress here. Do you feel it's worthwhile noticing earnings dates? Yes. And not trade through those dates? Yeah, I wouldn't trade through them. I'm not a big fan of earnings trading on equities. I would, if I knew that there was an earnings report coming up and I didn't have, you know, any information about, if I wasn't doing fundamental analysis, which I don't do, then I wouldn't trade through earnings. Just wouldn't do it. I'd wait until after. I mean, the play here There was some earnings announcement they obviously missed, right? And so right here, the day after, there was a weak rally up. There was your short opportunity to make money instead of holding on through a long trade in here. So that's how I would suggest you think about that. Okay, this question comes in page 21 of the slides, accumulation. When you analyze bar by bar, you give some of your thoughts, for example, on bars. Would you give some of your thoughts between D and F? Why are they meaningless or confusing to read? They're not meaningless or confusing to read. I just didn't want to spend all time on all bars here. What I wanted to talk about was, the areas in here and in here. These are primarily up bars. We've got volume not great as we're going up, which kind of gives you a heads up. But the real key thing was that we're back in the supply area, and I wanted to highlight these bars. It's not that these are meaningless, just I didn't want to note them, that's all. It was teacher's license, I guess, to emphasize certain things over others. When analyzing a chart, do you have a checklist or a series of questions that you automatically go through to come up with your story of what the chart is telling you? It's a very good idea. Have yourself a checklist of things to go through. Look at, if you're looking, is there weakness in the background? How do I know? Has there been climactic action? Has there been no demand? You can make up the checklist for yourself, and in fact I recommend you do that, that you make it up. And there's nothing wrong with having a checklist. I remember sitting down close in around 2006 or so when Serena Williams was playing a match, and I got to sit up close, and she was number one in the world, and in the changeovers she pulled out of her tennis bag a little checklist of things that she wanted to remember to do in this match. So if world number one in the tennis circuit can use a checklist, we can too, and it's a very good example. Do I have examples of stocks that are easier for beginners to trade? I would trade highly liquid stocks. If I were trading stocks today, I would pick out 10 to 12 stocks max and I'd just go to the Dow and I'd pick 10 or 12 of those stocks and trade against them. Trade highly liquid, well-known stocks. They're going to be the ones that are the best. It's enticing to trade things like, Facebook or Nutrisystems, or a few years ago it was Tazar, because they're rocketing like crazy. Those are the ones you want to stay out of because they're just too volatile. You want things that act and behave well. That's my opinion anyway. On chart 14 of 51 charts, numbers 2 and 3 on the price bar show heavy volume. When these heavy volume bars get tested, price comes back to test areas of supply and demand. Which bar gets tested? It's not which bar, and that's why I couldn't really figure out which chart you were talking about. But it's not the bar, it's the area. It's the area or the zone that gets tested, not the individual bar. So that's what you're looking for. And it's generally usually in the middle of it someplace. If it's lower than the middle, it indicates it's even weaker. But generally in the middle of the area. Shortening of the thrust, is this measured in waves only? No. And if so, how? Is it from, say, top or bottom of the wave to top or bottom of the next wave? Yes, that's right. It's from the top of one swing to the top of the next swing in an uptrend, or the bottom of one swing. So, for example, if we're going up, and these are the waves up, and we're looking for shortening of the thrust, we're making good progress from here to here and from here to here. But suddenly we start to shorten and we get really short, and I'm getting squeezed up there. And it's the same thing on the reverse. You'll see good progress coming down, good progress, decent progress, less progress, much less progress, and even less progress than that, and that's shortening of the thrust. Can this be measured from bar close to bar close as well? Yes, though I don't really do that. I look from high to high on the price bars or from low to low on the price bars. Do I use regular volume on your TradeStation charts? Yes. I don't know the only other option would be tick volume, and I wouldn't use that unless I was trading the forex currency pairs, the cross rates, because they don't have good volume, because the banks don't report it, which is one of the reasons I don't trade that kind of market. Do I format it? I just painted a bluish color, purplish color. That's the only formatting I do. I would like to see the Q&A at the end of the seminar so we can choose to study it later. Yeah, sorry about that. There's a lot. We're over an hour into these. There were a lot of questions, but we're doing them the first one. So we'll just finish up. In your first class on the language of the markets, you referred several times to a mature trend. In tomorrow's class, please speak to the question of how one gauges the maturity of a trend. Well, there is no, and now we're going to start getting into the material. This is going to segue us into trends. So this is the end of the questions. So you can all take a sigh of relief, I guess. All right. So anyway, there is no magic formula for how to figure out the end of a trend. You can certainly do it with point and figure charts, though even those are only really estimates and sometimes just guesstimates, not real hard and fast. People use them that way and they shouldn't, but that's the only thing that I know that's halfway reliable. Look at this chart, for example. This is Boeing, BA, right, on a weekly basis. It's a New York Stock Exchange stock. And we're obviously down here trading on this chart around 65 or so. And it goes all the way up to 70, more than doubles its price. When do we know it's over, right? Well, to me, it looks like it's getting there. How do we know it's over? The way to do it is not to say, okay, well, this must be a mature trend. It's more of, framing it out. We see here that we can draw in trend lines in here, a trend channel on this. And at A, possibly this is, we got a gap up. Is this an exhaustion gap? We've gone from whatever we've been at, 65 or so, all the way up to 100, near 120. That's pretty high. And we're at the top of the trend channel. So we're in an overbought position in the trend channel, and I get big volume, and I get a mid-range close on a gap. Is that supply coming in? Well, the next pullback will tell us, and look at what happens. The pullback down to 1 shows receding volume, and then we push up on 2. That's a nice, telling us it's going to go up higher. Look at the ease of movement that we get going up well above the trend channel. Okay, so this trend isn't over. A lot of times trends will go on farther than we would normally expect. I mean, that's kind of a characteristic of trends. They continue on, and they will continue on until either one of 3 things happen: a climactic action, volume comes, or selling comes in to stop the market, which is usually climactic action, or the market goes into the doldrums on low demand. We saw that in the first session. Well, here, I didn't mark this. I'm sorry. I don't know why I missed that, but this is B. Should be pretty obvious anyway. Well, we get up here, and as we rally to B, look at the volume going down. There's our first clue that something might be up here, right? That we're a lot of buying in here, a lot of demand, but suddenly we're starting to see the demand wane in here by the lack of fuel behind that push. Then at B, we get a spike in volume, and it closes mid-range. So we get a down bar at 3, but the volume's low, telling us it's not ready to go down yet. At 4, same thing. We're just not getting much downside volume here. It's so far as also a down bar. So it's no supply coming in here. So we rally up in here to C, and look at the last 2 bars, these 2 bars here, and look at the volume, fairly sustained, and we're not going anywhere. In fact, we get more volume on the second C bar, and we get a poorer close. We're having very big difficulty pushing over that high up in here, okay? And then the last bar shows us that the uptrend, for our purposes at least, is most likely over, and it might be a good spot to go short in. We're going to look at this in terms of multiple time frames a little bit later, and I'll show you a little bit more on distribution in here off of the daily chart to look at this and to read into it a little bit deeper. But the answer to the question, how do you know that the trend is over, is, you know, most trends will go, Elliott talked about this, and he talked about a wave up, a wave down, a wave up, a wave down, and then a wave up. And usually these, after 5 waves here, that the uptrend is typically over. Or the downtrend, you know, same thing in a downtrend. And that's an okay rule of thumb to use. But, you know, trying to do this, though, is obviously this was going up from before. Which is this a number 1? What is this kind? You know, Elliott wave is very difficult to do, and I wouldn't recommend anyone doing it. But you can kind of get a sense that, you know, here you got 1, 2, 3, 4, 5 up. So maybe now we're having an ABC kind of thing down. I don't know. I don't want to get into Elliott wave, but there's only a limited number of pushes up that you can get. I've seen it go, you know, on and on for lots and lots of waves, but that's not a bad little rule of thumb to think about in terms of a mature trend. So really, when you see a market go up and pull back and then coming up again, at this point it's getting mature. You want to see what it does on the pullback here, and if it's still on light volume, then you've got probably another leg or 2 up. But that's what you want to do, is see what goes on up in here once you get into an overbought position. So that's what I would suggest there. Would I put another supply line near B? You mean up like this? You could, I suppose. Like this? Yeah, you could. I was just trying to keep it simple. They get reset in a strong market, the Elliott waves. Yeah, I'm sure they do. All right, so now let's talk about trends. We spent a fair amount last time on changes of behavior and initiation out of trading ranges and all of that sort of stuff. But let's just look at trends just in general. So here's the yen. Let's really look at this and analyze this. All right, first off, we have these 2 really wild bars. And I think I mentioned this. We might have used this chart yesterday to some degree, or something like it, or last time. I wouldn't really know how to read this. But then we break down on to 1, and the volume's pretty good coming down, and we try to push back up here to 2 to get back up above the resistance. This is support, which now becomes resistance over here. And I have a high, a lower, a low, a lower high, and now I've got a lower low and an inability to get above resistance. And so I know that the odds favor I've got a trend now in the often, okay? And I'm looking for confirmation of that, and I get it on the very next bar, bar number 3. Look at the volume pick up as we come down. That's supply coming into the market, okay? And that's what we want to see. If we're looking to trade a trend, we want to see most of the down bars with increased volume or sustained volume. And we see that coming here on 3. Now we start to get a little bit of a pullback on 4, up to 4, and look at what happens to the volume. It goes down. So on the first bar, 5, that's a nice trade there. That's a spot to go short. It's a nice little, what I call a key reversal bar, where we go above the high of the previous bar, fail to hold there, and come down and close deep within that other bar. It doesn't even have to be deep within the other bar. It could, depending on how high the high is. But the idea being that it goes above that bar and comes down and closes on its lows or near its lows. And the next bar 5, we get pickup in volume. There's a struggle to try to go up higher, but they're not letting it, and they close it on that bar poorly. And then on 6, bang, we pick up more volume coming in. So we've got down bars showing us there's supply in the market, and up bars showing us that there's a lack of demand, a lack of ability of the buyers to turn the market around. On bar 7, we get a low volume bar. This is a classic no demand type bar. You can, they often will sell short just below the no demand, and so you would stop yourself in. If you were watching this intraday, you would start to see it falling down and trending down here in the Asian market for sure, and you'd be getting short, looking for a push down below the local low. Remember I said I'm always looking at daily highs and lows? So here's a good example where I want to see it clear. Hang on. I want to see it if I'm short in here somewhere. I'm trading the Asian market and I'm short in here. I want to see it take that yesterday's low out for sure. And then my next target is to see if I can get below the 2-day low. Okay? And it does, and it closes below that. So that says there's more weakness. And as we come down here, making lower lows and lower highs, I'm seeing volume picking up. This market is just weak. There's no demand at all in here. Everybody see that? Everybody understand this? You want to get in trends, and I'm showing you how to do it and how to stay with the trend. Okay? Everybody see that? Okay. Any questions on that? Okay. We're going to go on for a bit because I've got a lot of slides here, and I'm gonna not just stop us. We'll keep going. Okay, so here's a 5-minute chart of the S&Ps. Okay. What I noticed first on this is that we came down into this area with some ease of movement coming down, and now this is the Asian and early European session. I don't see any demand in here. Yes, we've kind of slid up in here, but there's really no demand throughout here. And in fact, where the higher volume comes in at A and at B, they're mostly down bars, and it took the market down. And in prior, into the Asian session, what I see here is volume picking up. Remember we talked about this last time? When volume and spread increase to the downside as we come into support, that support most likely is going to break. And that's exactly what happens in here. It does break. Okay? And then what do we see? Similar to what we saw on the yen chart, we try to go back up above what had been support, now is resistance, and we have low volume. There's just no ability of the buyers to push that up, and so then we start coming down. And remember, this is not in the most active part of the market. I wanted to do this for the folks in Asia because there's a number of people in Asia and Australia, and I wanted to show you that you can read the overnight as well. Look at the volume is fairly good all the way down to 6 here. And at 6, this is an up bar, right? It's still showing no demand. There's no real ability to rally this market. We do get a bit of volume in here, and that's going to push the market up. It tells us that we're going to get a rally, and we would look for this market to, sorry about that, let me erase this. We'd look for this market to push up to this part here, maybe go a little above it. Doesn't even quite get there. And as it goes up here on 7, look at the volume. Just dries up and goes down. And then as we drop down, we see on bar 8 the volume pick up again to the downside. It tells us that this little support, if we had a line in here, it's not going to hold. It just isn't going to hold. And then on bar 9, we try to rally off of that. Look at the volume. There's no fuel behind that. And we kind of hesitate, kind of hug the lows here for a bit, and then start coming down. And as we come down, the volume picks up again, right? And as we try to rally, here's another classic VSA no demand right here at 11. Just no volume, no ability to do that. Everybody see this? It's tough to see when you're in the middle of a trade, right? But this is important to understand. This is the characteristic of a trend. And the same thing here at 12. We see, so the things that we're looking for is we're looking for volume to pick up as we move down. And sometimes like this, it's going to ooze its way down. And then other times it's going to start showing us ease of movement down, right? As the volume picks up. So we're going to look for volume is the key, and then secondarily spread coming in as well. And then we come down to 13. Well, look at that. Notice I've got this in green. Why? Because look at the volume. It's head and shoulders above everybody else. Not a head and shoulders pattern, but a huge volume. And if we put a trend channel on here, we see indeed that we are oversold in the trend channel. And so that volume is coming in exactly where it's supposed to come in. And then we see a little bit of buying start to pick up. And I labeled that as multiple there of bar 14. And it looks like we broke the trend channel. And so now what I'd be looking for is what are we going to do? Are we coming back down, and how are we coming back down into this area here to test the high volume? So far, I don't like the look of that volume. Okay, yeah, 13 is climactic. For the 5-minute ES chart, what Weiss wave settings do you use? 3/4 of a point. 3/4 of a point. 0.075. Okay. Here's crude oil, 60-minute chart, including the overnight action. Because somebody in their question said, I don't really understand these little narrow range bars. All right, so here we are. Now go back over to this edge of the chart to begin with. We started coming down. We seemed to base in here, build a bottom on this day, and then we rally up. And I know that this is a resistance area here, right? Do I ever use Bollinger Bands? Asked Marilyn. No, never. 3/4 wave on ES and 3,000 to 5,000 tick. Yes, that's right, Bill. How do you recognize stopping volume in zones of support and resistance, as it also has a wide range with good? Well, we're not going to usually see stopping volume come in at support. They come to support to test it, not to stop down there. Where you will see stopping volume occur is on higher time frame support or resistance, like a daily low or a daily high. But we've already broken down, and now we're coming in. We'll see climactic action occur there, but not on simple support or not on intraday or local support or resistance. Okay, so let's go back to this. So on crude 60-minute, I'm at resistance, and we drive. This is kind of an oddball one, right? We drive up on good volume, and then suddenly it stops. And on bar 2, we come down on good volume. So I would be thinking at that point, okay, let's look to go short. But then on bar 3, look at what happens. We go right back up on pretty good volume. I'd be saying to myself, okay, that's an inside bar. Maybe it'll roll over and start coming down. I'd be looking at, this kind of a trend line. But bar 4 breaks that and does so on very good volume. So what this tells me is that all the supply that came in on 2, and I read that like supply, like something happened in here. Maybe the Arabs, were shutting off the oil or something. So something was happening in here. And the market's about to turn back down, and probably what we're going to get is an upthrust rather than a continued drive up. But by bar 4, that's telling me no, that's not happening. That's not an upthrust. We're coming back up above that. And now we come down on 5 and we're not doing anything. We're just going light in here in terms of the volume. And it kind of comes back. This is a little bit of testing, I guess, in the overnight market, overnight for me. And then it starts to push up a little bit more. And then kind of holds now really around yesterday's high. I'm not getting lower than yesterday's high. And then we start going up. Now later on I'm going to show you how to mix this with the intraday to trade this, because it's very interesting. Here we thought, okay, at first we thought it's breaking up, then we thought it's up thrust, then it's clear, it's holding. So now we want to be buyers in here, and I'll show you that a little bit later. But what are we anticipating? If we're going to continue to go up, we want to see good spread, good volume, and we get that in spades in here. This is beautiful. It's a beautiful push up. And at 8, we get a down bar, but look at the volume recedes. So we know that this is going to try to hold. We may get a little pullback, but we're not going to get a big pullback. There's no supply there. Okay. So now we can put our trend channel on, and even though this is at the trend channel, and we know that at that point, this movement back to 9 is not all that big a deal, right? But part of the question is, when do we know that the trend is over? When do we know that it's mature? Well, we start breaking up above the last high here, really at A. We're bars before A, and they tested it a few times. They drove up. Look at, though, at B, what happens here. Look at B. That's the first clue. High volume. It's less than the others, but it's very high, right, on down bar. And then the next bar drove back down and then pushed up on very high volume, the highest volume. The next 2 bars, no demand. See it? No demand. And then, boom, we get supply come in. So this now is over. This trend is over. And the next day, we flirt with yesterday's high. We come back up around it. And we do so on what? No demand. There's no volume in there. Remember, this is an hourly chart, so we'd be looking at a 10 or 15 or a 5-minute chart maybe for an opportunity to get short. And we'd have a nice little run down here, a good dollar move in oil. That's a couple of $1,000, right, per contract. So that's a nice little move, and it's all set up by playing the trend, understanding how the trends work, and looking not for, is it going to end on a Fibonacci projection or something like that. We look for the logical things to happen. Selling is going to come in and it's going to show its hand. Okay. Another way to think about this is that when we're in a trend, demand is in control. Okay. We see that here. We saw that here. We see it on the rally up to here. So supply has to show itself. Supply has to exert itself. Supply has to give us a change in behavior. And that's what begins to occur on B and comes in clearly on D. Okay. All right, questions. Was 1 to 4 a mini wedge? I don't know what those are, Bill, with 4 breaking out to the upside. I don't know what a mini wedge is. That would be a pattern of some sort of thing. On CL, to use 0.10 wave or on maybe a 2500 tick chart. Well, let's just focus on the. I forget exactly what I have on the. I think I use a 500 tick. I'd have to look. I can't remember offhand what I use for oil. Where I seem to have, but the wave is a 10-cent wave, that's right. Where I seem to have indecision is when I look to the left of the chart and see potential support or resistance, I tend to think that it may stop or reverse the trend line. How do I overcome this? You've got to read the price action. You've got to read the price and volume. So, for example, when there is a resistance point here, then we will we want to note that, and as we come into it, we want to see what the market's doing. Is the market rejecting higher prices and coming down? Here it started to look that way, but really there's no volume on that coming down. There's no, it hasn't really broken any, it hasn't really moved down very hard, and the very next bar is showing that it's still bumping up against this. And then by here, it's telling us it's pushing through. So the play is to buy as it comes back down and testing this in here. And we do that on a smaller time frame. Okay? I'm going to show you the day after this kind of move in here. This stuff here, we're going to show you on the intraday how to trade this. So hopefully that'll be able to answer some of your questions. Does an upthrust always have good volume? No, there can be low demand upthrust too. And there's also shortening of the thrust by B. That's right. Good comment there, Tom. What is your process interpreting a new bar on the right edge of the chart? Do you look at the volume and interpret the effect of the price bar, or do you look at the price action to see what the volume brings? I always look at volume first. Took a long time to train my eyes, but that's what I look for first. What's the volume doing? And then I look to see what price is doing. Any other questions on that chart, by the way? And these are good questions. Okay, everybody's good. Very good. Okay, so let's just take a look at oil on the daily. A recent action here. In terms of looking to see how we can read these bars, we start falling down. We're just going to start here at 1. We start falling down on widespread, high volume, down bar closing on its lows. Ease of movement down. No one should be missing this. Okay? Everyone should see this. It's also breaking support, at least what we've got on this chart. There may be other support lower down, but it broke that level of support. And that's a negative. Okay? If we go back a little bit, we can see that there wasn't much volume up in here and before this started to come down. So this is showing us that sellers have come into the market and are strong in the market. So we expect further downside. We get that on 2. Now we've got almost the same amount of volume, a little bit less, and not quite, maybe about what? Oh, maybe half the spread here. So we would note that, but still it's closing on its low. It's still negative. Bar 3, less volume, and again, we're not making much progress down. We're starting to see shortening of the thrust in the price bars. Okay? But what happens on bar 4? We have an up bar, narrow spread, closing in the middle, so it's not strongly up, and low volume, lower volumes. It's still heavy volume, but it's less than anything else in here, right? So I'm not seeing any demand coming in. And of course on bar 5, we get what we expect, more supply coming in. But now we have a pickup in volume. It's almost the same as bar 1, and we're not getting the kind of spread that we had on bar 1. So this is now starting to get long in the tooth. Okay, it's starting to get mature in here. And how do we know that? We're knowing it because the volume has been pretty heavy, and we're not getting strong ease of movement down like we were when we first started. Okay, bar 6, we get even more volume than what we had on 1, and again we're not getting the wide spreads down, and we're seeing now we're starting to close off the low here. We're not closing right on the bottom. Then we get an up bar, and we get an up bar on sustained volume. That's bar 7. That's our first clue that something we've seen shortening of the thrust in here, but this is the first clue that demand is trying to exert itself. Okay. Then on bar 8 we come back down, and volume dries up, and we are inside bar 6. Bar 6 was the low. We're not even able to go down all the way down to the low. Okay, and we start to get, so we've got demand and we have supply starting to dry up. Now, the next bar, A, goes down a little bit towards the low of 8, and then on high volume comes up and closes firm. This is the second indication that we have that buyers are exerting themselves in the market forcibly. And we have two indications where high volume is not producing the selling that we saw earlier on. So sellers, somebody's buying into that selling, they're absorbing that selling, and we have one indication that selling is drying up. Now at B, we get highest volume so far on the chart, and we're pushing up, and we're breaking up above the high of 4 and 5. Then the next bar, C, is a down bar, narrow spread, volume recedes. It's telling us there's no supply. D starts to go up, doesn't get very far, not a lot of volume there. They come back down and they spring off of the low of C on bar E, and then it's off to the races. All the way up, we get good volume coming in. Okay? What I call bar 6 stopping volume? Not really. It's just you can kind of see that we're way oversold here. We're coming down and down and down and down. It's almost like, remember I said a 45-degree angle, and I don't see 45 here. That's for sure. I don't know what that is, but it's much less than 45. So here we get a nice 45 going up. That's more sustainable. But this was an interesting chart because it turns on a dime, and you can read it. Now, would I be buying in here? No, probably not. If I'm intraday trading, I would certainly note that I have a 2-day high here, and are we going to get up above there, and can I get a test in here, and then I've got to get up above here, and then my target is up here. See, that's how I would target this. I'd be looking to get in somewhere around here if it showed me that it wanted to, or even here, and then my target would be around 5, and that's what happens. But to swing trade this, you're not looking to buy until maybe D, or I'm sorry, C. You're not looking to buy this until C. It's not really clear on a swing basis that this is going to go higher until this bar right here. You got all the indications going on down here, but this could fail too, or it could go down one more time and wash everything out before it rallies up. And on that shakeout, on that flush down, you'd be very hard pressed to hold on to your trade, because this is an expensive market. You'd be well underwater. Would bar 6 be stopping? Okay, we answered that. Where would you take the trade in this chart? I answered that. And would I have bought 4? No, I would not have bought 4. No way. We're coming down. And this is no demand. No demand. We would sell 4, if that's what you mean. I would certainly think about selling 4. If I were in the market in the intraday, I'd watch this rally up and look for it to turn and then start to short it. Or you could sell stop it under here. B is a sign of strength. Yes, B is a sign of strength. That's right. B is definitely a sign of strength, Jim. If you compare bar 6 with bar 1, narrow range for bar 6 with increasing volume, then bar 1, is it bag holding? Yeah, this would be a good example of bag holding in here. This general area in here. That's right. That they were holding the bag in here, which is just a way of. Wyckoff used to work on Wall Street, had his office on, it was either, I think it was 2 Wall Street, Anyway, didn't see his old building, but I saw the replacement building, the new building, and there was a post office nearby, and he would certainly see the postman. At that time, everybody was a man who did postal work. So he'd see the postman walking, along the street, and he carried a leather bag or satchel. And he would open it up and people would drop their mail in. Well, he used that as a sort of an analogy for what was called bag holding, that the postman is opening up his bag and saying, give me all your stock certificates. I'll take them away for you. Because everybody is scared down here that this market keeps falling and falling. And when is it going to stop? Let me get out. Let me get out of here. And you can see the sustained volume that's going on, and people would be selling. But matching that selling is the buying, and the way we know that is the amount of spread that's occurring on the bars and where the position of the close is. Okay. VSA talks of ultra high volume. How do you determine when a volume is ultra high? Well, they have certain formula that they do. You can think about it as a 2 to 3 standard deviations away from the mean. That's probably the easiest way to think about it. I would just look at it as sticking out there like a big sore thumb. Gavin talks about big, tall basketball players, sticking out there like a big amount of volume. And that would be I would just use my eye. I'd eyeball it. At the bottom of the trend, we are looking for absorption of supply, accumulation, and at the top of the absorption of demand distribution. Well, sort of, John. I wouldn't get too excited about that, although we talk about it here. I would just think about it as the market not going down anymore on high volume, and therefore the only way that happens is if buying comes in. So the buying is absorbing or accumulating shares. And at the top of the market, it can't go any higher, although there's lots of buying going on. Somebody's selling into it. Somebody's distributing the things that they bought lower down. Okay. How would I have shorted at the top? Well, you have a bit of an upthrust here. I mean, I don't know. We'd have to look at the background a little bit more. You certainly have this kind of upthrust going on. Intraday, you've got a couple of days down and a weak rally intraday. As it's coming down, you're breaking this. I'm guarantee it's testing that before it goes down. That's a perfect spot to short. I was really looking more at this little situation occurring. And then you would take a point and figure chart probably across this area here, and that would give you a projection up. Okay, so can we go on to the next chart? Yes. Okay, good. If you have more questions, we'll certainly do them. I won't leave this until every last question has been addressed. Okay, so we'll just take a little bit of time and look at the Weiss wave now for a bit, just as a break. And we're talking about trends, so let's look at the Weiss wave in a trend. Here we see this market came down, big volume in here compared to what we see over the next few days. We don't have this on the chart, but we can assume maybe this was some kind of climactic action or something in there. In any event, we get a couple of waves up and nice volume coming in here. Up to A. Then we get a pullback, and look at the low volume coming in right around the open of the US session. And we have a very nice bar here. Probably a little hard to see, but what I see here is that we started off with a little bit of a wide spread, then the spreads got narrowed, coming down. I also see they're not making much progress coming down. Okay. The shortening of the thrust and the price there. And then the last bar, this key reversal bar, here's a picture perfect key reversal bar. It goes underneath these 2 days, these 2 bars, rejects lower prices, and then starts up. and the volume is low, right? It's lower than the other couple of volumes on the way up. So we start pushing up, light volume in here, but all the bars are going up, or most of them are going up. We start to see a little more, we get a pullback finally here at D. It's like a grinding market going up. That will sometimes happen. And then at D, we get a little pullback, very light volume. Here's another little key bar that you can buy on, look to buy on. We get good volume coming in. Then we go sideways. I forget, how did I do this chart? We go sideways in here. Whoops, sorry about that. Yeah. So we go sideways in here. I didn't draw this line in, but we're not picking up any downside volume. And if we draw that line in, we have a little tiny spring there, or a small spring, which is worth buying because we're just going sideways. We're holding gains very nicely. We're not getting any kind of a big pullback. Volume comes in very good and continues through. Now, how do we know the trend is over? Well, we could put a trend channel on. I didn't do that in this case. I wanted to highlight something different here, and I'll show you this a little bit more, but just notice the wave down at G. Bigger volume than we see on anything coming down in the last 2 days. That kills the downtrend. That kills the uptrend. That killed the uptrend. So this went on for a day and a half until we had supply come in, and then it dies. I'll show you a little bit more about that in a few moments. Okay, here is, so that was going up. Here's one coming down. Can this be read? I think so. First of all, look at the fine amount of volume coming down here in the overnight. That's big for the overnight on a 3,000 tick chart. This is the S&Ps again. And so we get a little rally up, but volume isn't much. It's more than what we had on these little waves up, but these are kind of tiny. And then suddenly we get an upthrust here. This is another picture perfect spot to go short on that. I put the arrow in, and that's excellent to go down on. Okay, and volume is sustained on the way down. Look at these large volume waves coming down into C. Okay, then we rally up on D, pretty good volume. Okay, have a little pullback, not much volume. Then at E, we get another upthrust, just like we had at B. And look at the volume, it's so light. So there's another short, picture perfect short. Now we can draw a trend channel across the tops. As we come down to F, volume picks up. So see, it's the same thing in the waves as it is in the price bars. Remember we said in the price bars we want to see good spread coming down and volume picking up on down bars? Well, what we want to see on the waves is that generally waves are bigger coming down and at least sustained volume, if not greater volume, coming down. Okay, we rally up to the underside of the supply line, and G is another key reversal bar. We can short there. We don't see big volume coming in. When we come down to H, sustained volume, still making lower lows, lower highs all the way down. Little volume coming in on a little movement on that volume on I. It's showing that there's not much in the way that buyers can get in here. We get another key reversal bar here, and if we were to draw a line across these lows, that's support here, resistance here, and we can short that as it's coming down. And again, we get a larger wave down. We get just like a larger spread, and the volume is sustained. We come down down to J, and then we get a rally up. Now, here, this is interesting. Here we get more volume coming in. So could this mean? This could mean one of two things: either buyers are stepping in, or it means that there's an effort to try to rally. Buyers are stepping in, but the result is poor, and we know that it's the latter. That buyers are stepping in. They're trying to buy this, and we know that because we've got sustained amount of volume here. If all this was selling, we'd be going down and down and down, but we're going up. So there's some buying coming in, probably some higher time frame support. Well, we're right around, this was the other day, in fact, and we're right around 1800. So there would be buyers in here, wouldn't there? Because that's a big, big, fat, round number. So they're trying to buy it, but we can draw our little resistance line here from the previous support. It also happens to be a little bit of an upthrust off of this little swing high here, this mini swing high. And so we'd short it again right here. And this was just basically a trend day down that continued to go down and down. Now at L, I would see this and I'd say, okay, I got no volume here. I had higher volume coming in. I'm done for the downside. I would exit my trades. Any trade that I had left gets exited out here because the volume is low. It turned out that it continued to go lower, but that was the safe play. With bigger upside volume coming in here and then low volume, that's a recipe for a rally to occur. It was so weak it didn't do that this day. And I'd certainly note that 1800 value too, and I'd be very aware of that. And just thinking that this is probably, it's probably done in here. And so I didn't make the last 5 points. Who cares? I got my 3 to 4 points for the day, right? Okay, let's see. First sign of change of behavior. I don't know what was before this, Paul, so I can't really tell. I think we were just, I think that there was an this was Friday, and I think Thursday had a big up wave. And we talked about this in deep practice, how far up it would go, and I suggested right in this area was a good spot to see it die off. And then there was another area slightly higher. So it died off here. I think it broke yesterday's low by this point on that big volume. So that was not necessarily a change in behavior, just a continuation of the big move down on Thursday. But this was Friday's move, and this was huge. This was a big, big move down. So there was a lot of volatility in the market. We'll look at Thursday, I think, next. Let me see if that's true. Hang on a sec. Yes, this is Thursday here. Yeah, that's Thursday. So we'll look at that next. This was nice and clean and clear. To me, this is crystal clear because it there was so much volume in the market. When there's a lot of volume, that's one of the things that we look for. The more volume, the better the market moves. The more well behaved it is. Okay, slow grinding price movement up after a strong up volume bar. A common occurrence in the market? Yes, very common, very common. Did K fall because it wasn't oversold? K fell because of resistance and because there was such a strong down move for the day. There was no way buyers were going to come in. Can we take a break? We've gone for 2 hours. Yeah, you want to take a 5-minute break? A bathroom break? Yeah, okay, 5 minutes. We will take a 5-minute break and then we'll come back. I'm going to pause this. Remind me to turn this back on. I have a habit of forgetting that. Okay, we're back. And the recorder is started again. Just a quick couple of questions that people asked. Would I be making 5 trades here during the day? What I would try to do on a day like this, with seeing the huge volume that came in and the enormous volume that came in the overnight, I'd be looking for a trend day. So I try to put a core position on, maybe either at B or certainly by E. I would have one on, and then I would trade in and out of these little waves. But I try to hold a piece of my core position that I bought or sold somewhere back in here through the day, and probably hold it right into the close, or at least down to L here, and short here and then cover as it was pulling back over here. Try to short here, cover in here, short and cover, that kind of thing. And we are recording. Why do point and figure charts work? I don't really know, tell you the truth. They just kind of give us the horizontal. Is the Weiss wave indicator available for Thinkorswim? No, it's just available for Metastock, I think Ninja, TradeStation, one or two others. You have to look on the website. I forget what they are, but it's not available for everything, and we won't make it available for everything. We'll just use it really for. We just make available what we trade, what we use in our trading. This is Wednesday's low. Wednesday was a fairly narrow range day. Couldn't make it up to the high. It came down on good volume, broke that, tried to rally back up, and then here came down and tried one more time to rally and failed to do so, and this was the spot to take the trade. There was nothing really up in here. There was a little bit too much volume, and there was no indication here that this was about to turn. But at this point, it certainly did give us a good indication. We come down again on good volume here. We try to rally back up. Look, there's pretty decent volume on D, but look at how little we travel. So there's an effort to go up, but there's just no result in that. They're just not getting rewarded. As we come down, seeing this effort versus result, another good spot to go short. We come down to E, there's nice volume building to the downside. We come up to F. Again, the volume's not as high, and we have a little up thrust. This is Thursday. Harder day to trade. Nothing really you could do in here, except for kind of hold your nose and jump in if you wanted to. G looked like it was potential climactic action in here. That's how I interpreted it to begin with. And then I see the high volume come in at H. And I thought, okay, we're going to stop in here, come back down, test G. Maybe I'll start looking for a long trade. But then we go sideways for quite a bit of time, and about 40 minutes, and we get no upside volume. And then we get this negative indication here, this negative bar here. Perfect spot to go short. And then it comes down. You can at least trade it down to G, and it turns out it goes a little bit lower. But you know, that was a nice 4-point trade in there. So any one of these on a day like this can easily make your week, not only your day. How would you know when to make those small covers? I'm reading the price bars as they're going along, and you know, here's one. I want to be out there. I might be, you know, thinking about getting out here. Or down here, I get 2 bars in a row that are showing me that they're not going to go any lower. It's all in the price bars and the volume. It's easy to see post facto. Right, Bill, it is. Absolutely. It's so easy to see this in hindsight, it's almost ridiculous. You say to yourself, how come I can't see it in the real time? And the reason is that it hasn't been practiced. I have 15 years of practicing this stuff, and I still practice it. And I have 15 years of studying charts and trading them and everything else, and so I can see it real time. David Weiss has 45 years doing it. He can see it real time. Tom Williams has another probably 50 years. He started before all of us, and he can see it real time. You know, you can't just say, oh, I can look at a chart and see it in hindsight, and therefore it's you know, how do you do it in real time? You do it in real time by developing the skills to do it. It's all there on the chart. Okay, so here's a little bit of advanced ideas in the Weiss wave. You can see here we're coming down to A. I don't remember. This was a recent day, but I don't remember which day it was. We're coming down to A. Not a lot of volume is being built here, is there? We rally up, nothing to speak of, kind of light volume on the rally. Then look at what happens. We come down to B and we get more volume coming in. Well, there's an effort to go down, but something is preventing it from going lower. What is that? It's got to be buying. Okay, there's a lot of volume coming in, but it's not going down. And this is well after the U.S. Open. The U.S. Open is back in here somewhere, back in up in here. Okay, this is now an hour after the U.S. markets have opened. So then we try to go up, and we don't go very far, but suddenly we get more volume than we had before, and certainly than we've had all morning long. Okay, and we drop down again. Once more, we get large volume coming down. And you would think that it was so easy to move the market on so light volume over here. Well, now we've got good volume coming in, and I can't get much below the morning low, the early morning low, the early U.S. morning low. And I can see and hear the price bars are trying to hold in here. They're trying to. There's a lot of buying going on in here. And then we get that good buying coming up. This is very similar to that crude oil daily chart. What was going on there, right? Now we get a push up in this wave. We get very good buying coming in. And now I'm looking for a long trade because now I'm pushing up above the previous highs on good volume. And now I'm looking for a higher low. And that's where I want to try to get long. And then I'm going to look for confirmation on that with a push above, making a higher high. And we pull back, fairly modest volume for now what's going on, and I get a key reversal bar on that first green arrow. I'd buy that. And we're buying in, I think this is 31.75, I think this was. So you'd set your stop at 28 and a quarter for a 3-point stop, or whatever that is, 28. Yeah, 28.75. Sorry about that. My brain just seized there. So that would be the stop level right in here. And it comes back down again, but look at the volume coming down to G. So if you didn't buy it at F, then certainly G, or you could add to it. But even if you did buy it at F, at a 3-point stop, you're fine in here. And now you've got a move that goes somewhere from 32 up to around 30. You've got your 3 to 4 points for the day. Okay, but it's reading this through here and knowing that this is a choice point in here to make the trade. You can try to go in here, you can be aggressive and try to buy this. It may or may not work for you. I've seen a lot of times where this does fall down. But once this occurs, where you get nice demand showing up clearly, here you're still wondering, is supply going? There's a struggle going on in here. There's a battle. Sellers come down, but buyers seem to be meeting that. Then buying comes in, but sellers come down in again, and they do make a lower low. Big volume, not making a lot of progress down. It seems like buyers are stepping in. Is it really true? I really want confirmation. And here is the confirmation. This is the sign of strength or the real change in behavior that occurs. And this is what we hang our hat on. And now we go in and look for an opportunity on a weak pullback. And we get it at F and G. And either one of those is fine to make a trade on. Has the recording been started? Yes. I don't see the blinking bars on the far corner. Well, as far as I can tell, it's recording. I can stop it and try it again, because boy, I don't want to. Yeah, it's recording. It says it's recording. Okay. And does the Weiss wave work for securities? Yes, it does. It works for all markets. Everything we do works in every market and every time frame. Is that a spring above the letter D? Technically, yes, it is. It also looks like a spring at G. Yes, that's correct. So there's a spring there too. Is it a spring? Is G a spring in an uptrend? It's not quite an uptrend yet, but it's getting there. The break and close above higher resistance. Well, it's putting in a new swing high here at E, right? We have new swing high. So what we're looking for is a higher low. And if it's coming down on weak volume and the market starts to turn, we're betting that that's going to be the higher low. That then is going to push up above and give us a higher high and give us an uptrend. Okay. Here's something in the yen. And you can see here, this is a 750 tick chart. It's nice and clean. We have an up thrust. This is yesterday's high. We have an up thrust here. And it comes down strongly. We see big pickup in volume coming in. And then we get a rally up. And then it pulls back and we have another rally and we have an opportunity to go short at C. And look at the low volume here. And we would go short at C. But what happens? It doesn't really produce much for us, does it? We come down, but it doesn't go all the way. It has to come back up again. And look at the volume coming in at D. It's almost the same volume as B. Not quite, but almost the same volume as B. So we would expect, if this was all buying in here, to drive up and through and maybe try to test and push up above A, right? But that doesn't happen. It dies out at the top of C. And we have an effort then to go up with no result. It dies at resistance, and we get a reversal, and we can go short there. And then, as it starts to come down, we see the volume coming down for us. Aston, no. No. Okay, any questions on that? This is a little more complex kind of a situation. But it's worthwhile knowing about. It's tough going short on D. Yeah, it's tough going short on D, but that's why I put it up here. You got weakness here, ease of movement down, good volume. You have no ability to rally up here, and now as it comes back up the second time, you've got a lot of volume coming in, but it's not going anywhere. You have to be able to see that to make that trade. Okay. Ease of movement is one of the keys. Yes, it is. Yes, it is. Okay, good. Yeah, somebody's got problems with sound. Some folks have problems with sound, and really? Okay. I'll let you out. No, over here. We changed the door, remember? Okay, sorry about that. I had to let Asta out, otherwise he'd harass me. So here, we talked about this a little bit earlier, and I said I wanted to show you this again. Here we've got an uptrend, a grinding uptrend, and we can put trend channel on here if we want to. Yeah, let's do that. But the key thing is, it should be jumping out at you, is that here we go, we're going up, and then suddenly we get this large volume down. It's the biggest volume since the uptrend began to the downside. Look at all the light little, it's a grinding up move, so we're not getting a lot of swings in here, but there's just not that much volume to the downside. And then suddenly we get the volume to the downside at B. Well, if we take a look here, we get overbought up at A, and we're getting light volume when we're overbought. This is A here. So that tells us that demand is tired out. It's exhausted itself. Now we get B, so we know, and that just knocks the market sideways. And look at what happens here at C. We get a lot of volume coming in, but no ability to go up. And I think this market starts to fall the next chart. But what I wanted to show was that this is the key thing in here. It's just like we saw in the price bars. The principles are the same. When we were watching an uptrend or looking at an uptrend, and then suddenly we had a bar with large volume coming in, and it's a down bar, and it's closing poor, and it's early up in here, and we said that the trend is over. And it's the same thing here. The trend is over. And that has pushed the market down a little bit and then caused it to go sideways. Okay, some questions here. please repeat the last few minutes as there was no sound. Linda, you'll have to pick it up on the recording because I want to get through this. We're already 2.5 hours into this. You've mentioned and illustrated key reversals several times. That has been most illuminating, even though not highlighted. Good, good. Yeah, they're just simply bars like that turn around and close well into the other bar, into the previous bar. Here's a nice one right here to the upside. There's a good key reversal bar right there. Here's another one here. Those are just, and here's another one here. Those are just telling us that the market's going to try to drive up higher. Okay. Sometimes they'll come in clusters like this. There's a good example of you've got buying coming in. Only buying can do that, nothing else, right? If they were selling in here, they'd be closing on their lows and they'd be driving down. But they're holding in here. They're holding the market, and they keep driving the price up and closing it higher. It's not a surprise then that this market rallies up like this. Okay. Same thing here. We're coming down and down and down on a reaction. And then we get a key reversal right at our trend line, our support line. That's classic. That's classic when we look for stuff like that. We get reversal bars here on C. You know, we get these little bars here. So we look for that. Okay. Climactic volume before the big down. I don't see climactic volume on this. We just got overbought in here. C is the upthrust. No, there's no real upthrust in here. An upthrust would be coming up above A here, but it's not really happening. Jocelyn said I had problems with sound and then went to mic and speakers on top of the audio box, clicked on the settings and my audio video. Yeah, that's too complicated for me, Jocelyn. I'm sure. I mean, that's, you know, that you're going to everybody's going to have different software on their computer. So you can check your audio settings, as Jocelyn suggests, and you might get you might switch things around and see if you get better sound. Can you use shortening of the thrust with the Weiss wave? Yes, I described that earlier, Edwin. I did. At A2, I don't know what that means. Oh, you mean reversal bars? Yeah. They're showing, these are the same as here, just in reverse. Shortening of the thrust, change of behavior, largest down wave since the uptrend began. Largest supply as well. That's right, Stephen. All of that is right. Would I short on C? Yeah, probably. You noted, let's say, 70 to 80% success rate on trades. Is the trade here, you know, like trades like this, they should be well into the 80s. Is the trade futures due mostly to anomalies in the market or mistakes you made? David, the market is this is probabilities. That's what we're trading on. I'm trading on probabilities, and I also have psychology. And you know, I also am a human being, and I'm tired on days, or I miss stuff. I don't read the market correctly, or my emotions run hot or cold. They can do that to me. So you know, all kinds of different reasons for losses. If you're looking for 100%, this is not the game for you. You've got to be kind of like a baseball player where you go up to bat and you're going to be struck out many, many times. What are good ball players? 350, 360 are really, really good. That's 3.5 times. So 6.5 times out of 10 they get up to bat, they're getting struck out, or they ground out or pop out. Only 3.5 times out of every 10. Think about it in terms of like 100 times at bat. 35 times they get a hit and get on base, and 65 times they don't. You know, people trade that way because 35 times, really it's probably more like 40%. 40% of the time they're getting tremendously good trades, and 60% they have losses, but they're quick to cut those losses. If you're looking for 90, 100%, it's just not going to happen. There's no playbook in the world that I know of that hits 100%. Just isn't there. You got to get your head around this. You've got to stop thinking about how do I not have losses, because it's a probabilistic game. You're on the wrong side of the probability curve. The probability curve says that there are going to be a certain probability of winners and a certain probability of losers. Losers are a certainty. And if you're trying to avoid losers, you're on the wrong side. Come on, Esther, let's go. Okay, let's keep questions then to the price bars and the volume as much as possible here. A 300 hitter is a Hall of Famer, yes. 310 momentum oscillator, I'm not going to cover that. Okay, so I think we've covered this one. You need to practice, and you need to be thinking about probabilities and not get so fractured when there is when there's a loss. Okay, let's talk a little bit about distribution. This is a monthly chart of the yen, more or less correct. It's a monthly chart, and people wanted to talk a little bit about distribution. Well, we're in an uptrend, and we can put in lines and stuff, but I don't really want to do that. You can certainly see, though, that we're in an uptrend. At bar 1, we get a clear indication that some selling has come into the market. Okay? Now, even on a monthly chart, it doesn't mean that things are going to turn around right then and there. We want to see this get tested. This is the way of distribution. And on the bottom, it's the way of accumulation, because if the market just started to fall from 1, the larger players would never have an opportunity to get a good line of contracts in this case, or stock if it were in equities. They just wouldn't be able to get a good amount of inventory, because if they sold as much as they wanted to, they'd immediately drive the price down against themselves. So they have to allow it to come back up again. And so at 2, when we come back up above 1, what do we see here? We see a lot of volume come in suddenly. In fact, before 2, the volume is going down as we're rallying up before 2. Not a good sign for the buyers. That's the second. So we got on bar 1 we have supply. On the rally up to 2 we have no demand. Okay. Then on 2, the bar before 2 looks really good. It looks like it's closed up above last month, and it looks like it's gonna go higher. But the next bar 2, look at the volume come in and look at the lack of progress. There's just no progress going up. Okay, that's effort to rise and no result. There's no reward there. We have a month of indecision after that, and then on bar 3, oh, I forgot to label this, I'm sorry. On bar 3, we come down and we see more volume coming into the downside. On the rally up to 4, we see again no demand. Distribution or accumulation are processes. This is a process that we're watching unfold here. It's this process that allows the large traders to get a large line or a large inventory of short contracts in the yen that they can then cover much farther down, because they're making billions and billions of dollars on this stuff. And then from 4 we drop down to 5, and we see a pretty good swing down, pretty good ease of movement, and we see volume pick up to the downside. This is your primary distribution in here. Wyckoff would say that the move down to 5 breaks the uptrends back. Okay? It breaks the uptrends back because of the ease of the movement and the amount of movement down. Secondary distribution occurs here at 6. As we try to rally back up to 6, look at what we get. Very light volume on the rally up. Okay. So on a point and figure chart, and I'm not going to go into that tonight because we're not really discussing that, you would take a count across this line, whatever it is, maybe 1.27, somewhere's in there. And this would be your count, and then that would project down how far this market could move. Okay. And okay, so pros always seem to want a retest of any impulse move, it seems. Sure, because they want to do two things. They want to, sweetheart, can you please get him to do whatever he needs to have done? The pros want to do it for two reasons. One is to test to see if there's any more demand up there, right? Because they started to short in here. What if they started to get, bars going up like, let's see if I can find a good one here. I don't see it here, of course. But if they started to get real movement up on high volume, it would be hard for them, and they'd have to take a loss. And sometimes they do take losses. So that's one reason why, because they're probing to see if there's demand left. But another reason is because they want to bring the market back up and encourage other people to buy as the market goes up, because most people buy on the rally, on the rise, and they want to sell into it because that's how they get their contracts. They have to have buyers in order to sell. If they're selling down here, they're putting the price against themselves. So they're always selling as the market is as the market is rising, and they're buying as the market is falling. That's how they do their business, and we should do our business that way too. Would I wait for 6 to short? Well, let me show you how I would do this. This is a monthly chart, so it would be a little hard pressed to go in right on that. But this is the same area. I put 6 up here. This is the same area on the weekly chart as I had on the monthly chart. Okay? And so we can look at this a little more closely in here. As we come to this area, now I'm starting to show you, we're going to start to get into multiple time frame analysis, and then we'll be finished. This is I'm sorry we've gone farther. I didn't expect the questions to take so long. But you've got the recording, you can go back to it, and you can pause it and stuff. So we get an upthrust at A now on the weekly chart, and on the daily, you go down to the daily too. We're not going to do that, but you get the same idea. On B, we go down. Yes, we do come back up again, but look at that volume. That's got to mean selling in there, right? That's got to mean selling, because we're coming down first and then we're coming back up. And then on C, we're unable to get above that resistance line, and there's no demand left again. And we drop down a little bit. We see volume pick up on the bar between, on the week between C and D, and it closes poorly. It says selling is there. And then this is a classic no demand right here on D. Classic no demand. So you look for opportunities to short on the daily, really, at A, maybe at C, and at D. But on this chart, let's just say you were trading this, because a chart is a chart, right? This would look similar if it were a daily. We could cross this out, and you wouldn't know what the time frame was. Only because I told you this is a good spot to trade, this is a good spot to trade, and this is a good spot to trade. Okay? And then you're looking for it to push down below here and drive on down, and that's what it does. Okay, B finishes firm up. Yes, but then there's no follow through at C, and we have tremendous distribution in the background on the monthly chart. So you want to just not look at one bar. You want to be able to read what's going on in the background as well. All right, let's take a look at more distribution here. Here is a recent chart of Facebook, daily chart. Okay, and we'll just go through this one bar by bar and take a look at this. So we get good movement up here, but at bar 1, we start to see shortening of the thrust and very light volume. Very light volume. So it suggests no demand up there. And on the move down to 2, we pick up volume. Volume increases to the downside, and the spreads widen. Look at all the spreads coming up. This is another thing you can do. All the spreads coming up are, average spread, and then suddenly we get above average spreads coming down. Market stops at this point. We start to rally up. We come back up into the area, into the highs of 1, and look at bar 3. We see an increase in volume over the prior bar, which had pretty good spread on it, nice spread on it, and suddenly the spread narrows. Remember we were talking about bag holding before? Well, this is capping. So instead of the postman holding his bag open and say, put all your stock certificates in, this is like there's a ceiling here. And everybody's trying to buy above the ceiling, but somebody's up there just standing on top of it and capping the market off by selling into it. Then the next bar 4 shows us that there's very little demand left. It's dying out. We have no demand there. And so on 5, we have an up thrust. That would be an okay place to put a trade on. Or the following bar 6, which is another no demand. We come down to 7, and we notice that we're not getting as much volume coming in as we did at 5, and suddenly the bar turns around. So we have a choice here. Do we hold on, or do we pitch that trade out? I probably at this point would pitch the trade out, thinking that I'm not reading it very well. So I'd scratch on the trade. And depending on where I got in and depending on where I got out, I probably didn't lose all that much. Maybe a little bit. Okay? And that's the mental side of the game. We go on a little bit longer, and what I see here is that the volume is just, 2 bars after 7. I should have probably put this in here. Is this volume here. Another indication of no demand. And then on bar 8, we get an up thrust, and now we're coming down. Okay? So there's a little distribution that went on in here. And sometimes distribution, if we get short here, maybe we're premature. It wouldn't have been the end of the world if we had our stop up here, a point, say, away from, or a point or two away from the entry, $2 away, something like that. But it would be uncomfortable to sit through all of this. And your mind would start giving you all kinds of stories. It would be telling you, well, all the lows are lifting. Maybe this is just going to push through, and you that kind of strain gives you, it causes your mind to start to defend for you, try to protect you, and then you're going to make bad decisions. Better to, if you're not sure, it's better to scratch out and wait and be patient. Sit on your hands and see what unfolds. At this point, it's pretty clear that this thing isn't going to go higher. They've tried to go through that on, think about it this way. 1, 2, 3 times, and they strike out, right? The old baseball thing. They had buyers had 3 opportunities to push this market up above 1, and they failed to do it. So you got to give it to the sellers, right? Now, you have to look at higher time frame when you're doing this. And this is where we are on the weekly chart. So maybe we continue to go down, but maybe we do this. Okay? Maybe we come down, we test this area in here, come back up, we see shortening of the thrust occur in here. We could put a line in here, we get an up thrust here, and then we would have a nice trade to the downside, potentially. Okay? I don't know if that's going to happen. This is a live chart, basically. I don't know that that's going to happen. But what I'm trying to say is this, that if we go back up here to the daily chart, this could just continue going down. No question it could do that. But the odds of it doing that are pretty low given this chart and given the structure on the weekly chart. So I'd be looking, you might see that this, springs here or goes down into this area, 50, and then tries to move itself back up for a month or two, then does this. But the point I'm trying to make is that there's not a lot of, if we were to run a point and figure chart across the 58 level, there's not a lot of cause. There has not been a lot of opportunity for the pros to get short on this. So it wouldn't be a choice stock to look for a big, I'm talking about getting back down into the 35 range in here. If we do this kind of a thing here, coming back down into 40, 35. But I don't think you're going to see that off of this little bit of distribution that's occurred. Okay? So 2 bars to the left of 1, what would you be thinking of with all that volume? Yeah, I knew somebody was going to ask about that. With small range and all that volume. I'd sit on my hands and wait. I wouldn't know. You're talking about this bar. I wouldn't know exactly what to make of that. That there was a huge amount of volume in there and it didn't go anywhere. Was there some block trades that got made, that got put in here? There's all kinds of funny things that go on with volume. So I wouldn't know what to make of it. I'd note it, but even, there's probably was some distribution in there. But even through all of this, I still don't really know what that volume is. I can't really tell you that it was buying or selling. Some things I just don't know. Do I enter a trade on the daily? Not too much anymore. Sometimes, but not very often, because I'm so close to the market. Okay, let's now get into multiple time frames. We started getting into this, and now I want to go into it a little bit more. We'll focus in a little bit on tick charts for a moment here, but this is a 27,000 tick chart. In other words, there's 27,000 trades or changes of price in each one of these bars. And it's a very valuable tick chart. So here we are. We try to drive up above this resistance that I have lined here in blue, right? And you would think here that we drive up above this. Now we finally broke out and we closed above. That looks good. But look at what happens on B. It becomes negative. And I didn't put B here. I guess I should have. But look at, there's no volume to speak of. And then C is also, we start to see a little bit more volume. But the bars themselves are telling us that this is weak. Okay? So how would we, seeing this, how would we use this information? Okay? So here, now I've got a 3,000 tick chart. And I've placed A, B, and C exactly where on the 27,000 tick chart A, B, and C are. So this is, you get the idea, right? Okay. So now I see that we make the high at B. That's nice. We come down, got some volume. I don't know what to make of that at the moment as it's coming down. And then we rally up to C. We go to the top here of C. And as we start coming down, I notice we don't have much volume there. Okay? We don't get any selling going on here at 2, and that's because we come back down to this blue line here. Right? We come back down to the what should be support. And so it hangs there for a little bit, and then it starts to rally. And it comes up, and it starts to fail right in here. And it has a little minor upthrust right here off of this high. And what I notice is that when this wave starts to flip, there's just no volume up there. And that's not going to continue to go higher. Okay? And I already have these 3 bars already painted. So in other words, this has come up once again into here, and now this is the situation I've got. So I'm going to go short on this. And that's exact. And now I'm looking for bigger waves down. I start to get the bigger wave, and then the bigger volume coming down, and then we're off to the races, and we get a nice trade. There's a good, from 84 down to 26. There's a good 8 points in there. That's a nice trade for the S&Ps. Okay, you see what I'm talking about? The higher time frame is telling me it's having real trouble going higher. So I'm going to look for an entry, my first plausible, decent entry on the smaller time frame, and that occurs here. And my stop goes here, and we're off to the races. What reversal am I using? It's the same, 7 3/4 of a point. 2 bars to the left of 1. What would you be thinking real time with small range bar with huge volume? Oh, we already talked about that. Do you enter the trade on the volume daily? We already talked about that. Any questions about this? Any questions about this chart? You understand what I'm trying to show you here? What's the 3,000 or 27,000 comparable? This is probably like a, I don't know. It's not really comparable because time doesn't matter in a tick chart. It's not based on time. It's just what looks good to me. Okay, I said we would go, we'll get off the tick charts now. I said we would go back to this crazy day here in the 60-minute crude oil. And how would we trade this? Because now we're saying, okay, the market is up. The market is now up. And how do I trade that? Okay, so let's go to the 5-minute chart. And so in the overnight, we just extend this. I'll go back for a second to orient you. What we're seeing, I ended it right here, and what we're seeing on the 5-minute chart where I drew this blue line here on the 5-minute, which will show up in a minute, it's this line here, okay? It's this area here. So you get a sense of what I'm talking about, okay? So here we are on the 5-minute chart. And there's nothing to do in here. There's no trades to make in here at all. Okay, nothing to do but sit on your hands if you want to have high probability trading. What I see though is suddenly the market takes off to the upside, and I see volume expand to the upside as the market's rallying, and I also see it take out that high. Okay, that's positive. Now I'm getting interested. So I draw a line off of that last swing high, and we come down, and I notice that as we come down, volume recedes. That's a good sign for me. And as we come down to B, there's a spot to go long in here. It's just to buy this somewhere in here. We rally up a little bit, we come back down, and I notice that we have no supply where I'm looking for no supply. This is where the 1 bar is important, so you can also buy in here if you want to. Doesn't matter. We push up. This is what I'm looking for. I'm taking out the high at A, and I've got good volume to the upside. Yes, we're closing off of the high in the middle, but buyers are pushing this up. Some selling is coming in. So what happens next? Well, we just go sideways, right? And I don't see volume coming into the downside. In fact, we're kind of holding in here. And what I see instead is that we get a little spring. We go underneath the lows here, along this range in D, right here. And then the next bar is a nice strong bar. That's a good one to buy on. And what I'm looking for is to take out C, and I want to see volume come in, and that's exactly what happens here. Okay? Exactly what happens. We've got ease of movement up, ease of movement up, ease of movement up, no supply, no supply. And let's take a look at what happens after F. We get a little bit of selling coming in here, no question about it. So, but 2 bars are not going to change all this background and all the stuff that's going on the 60-minute chart. So now I want to see what's happening over here. Okay? And what do I see? I see volume drying up again. So I'm good. I hold. And what I'm looking for, take out the highs, ease of movement, good volume coming in. And that's exactly what we get. And we put on our trend lines in here, and we can see that we're getting overbought. And then when we come up to J, we're still overbought. But we basically close this on this morning firm. You know, we come into the morning where it's been a strong move up. Okay. If volume were coming into the downside, what would it look like? Well, it would look like volume increasing to the downside. We saw that earlier in several charts. The trends coming down, where we were in an uptrend and suddenly we got large volume. I would suggest that the best thing to do is to take a look and review that, and you'll see what I mean by that. Okay. How do I recognize a bull or a bear trap? I don't think of a bull or a bear trap. I think of springs and up thrusts. That's what bulls and bear traps are all about. Try to get your head out of the all of the stuff that's written about these fancy names and everything else. Put your head into reading the price and the volume. If that's unless you want to do indicators. Put your head into reading the price and volume, and forget about short covering, forget about all that stuff. Bulls and bears. Not bulls and bears. Bull and bear traps. Forget about all that. 2 bars after G. What about 2 bars after G? We're just trying to go through. We saw supply here. We're seeing a little bit of supply here too, and so we would be caught. I don't see volume coming into the downside. We see good volume coming up, and as we pull back, volume recedes. Okay, and so if this were to be a problem, it would turn and would take out the low of G on strong volume, but that doesn't happen. Okay. Then we bought down in here and down in here. We bought down in here and over here, so we're fine, right? We're fine. If that does happen, if this suddenly turns around and we get a down bar like this and the volume is 2 bars after G, so the volume goes up like this, then we close out. We still got profit. It's the other thing. I'm not trying to buy the low tick or sell the high tick. I'm looking to take a piece out of the middle. Remember, 3 to 4 points a day. That's what I'm looking for. Consistent, good profits. That's what professional traders go for. They don't go for home runs. When it's clear there's a trend day at hand like this, or the one we saw Friday and Thursday, then we try to hold on and try to make more. But generally, we're looking for 3 or 4 points a day. That's fine. At the moment in time of the huge volume in C, would you have at least been wary? I would have noticed it, and I would have said, what's going on there? Some selling came in. Maybe there's some resistance on a higher time frame somewhere. But I'd want to see how it unfolds. This does not make me want to get out. I found the following quote to be very educational. 2 bars do not change the entire background of the chart. Right. And that's a good point, Edmund. This 1 bar here does not change the 60-minute chart, right? Don't forget that. And it doesn't change that we just broke out of highs here. We might start seeing volume coming into the downside, and then we'd have to scratch out of the trade and say, okay, something's wrong. Let's go back to the drawing board. Okay, let's go on with a chart here. Take a look at Apple. This is a weekly chart, okay? And so we see on Apple, we see good ease of movement up, volume expands to the upside. We see the market come back at A, some volume comes in there, but we're at a support point, and at B, we turn around, We come back up to C. This is interesting. This is why I selected this chart. This is very interesting. We come into C and it looks like, well, what's going on here? We got volume at A. Is there no demand now? But look at what happens at D. We dip back down and look at the low volume. So it tells us at that point that that this is not supply, that this was just a shakeout, a drive down to flush out premature longs, people who got long up in here, scare them out, take their contracts, and then off we go, right? So we come up to this point. Again, nice movement up, good volume comes in to the upside, and then we start to go sideways. And we're holding on this high. And we've gone 3 weeks now, and we've not gone anywhere. And look at the volume, how low it is. There's no supply here, right? Does everybody see that there's no supply? Okay, good. So I move on then to the daily chart. And this is where I am at F. I'll go back up. So here we are at F, right here. And this is the high, and there's 3 weeks in between here, right? So here's the high, and here's the last bar of F. That's where we are. Do we see supply here? Well, we saw some supply coming in. Well, let's go to the next chart. I think I labeled this. Yeah, so we see some, we try to rally up and we get effort to go up with no result on this day. Then we get this big down day. That looks negative. And I would be thinking, oh, something's wrong in this market. But then we go for a week and a half or however long this is, and we come back down to this area and look at the volume on 3. There's nothing there. And that confirms what we saw on the weekly chart. There was very low volume on those 3 weeks coming down after this one week here. And then here we are at F, and I see that the market is starting to rise up a little bit, and we've got volume coming in. Okay? So now on the next week, I'm watching this, and I'm looking for a good opportunity to go long. On the next week, what I see here is that we come down from 4 to 5, and I have no volume coming into the downside. We come back down to the lows here, and I get a reversal bar. I'm long right here on bar 5 because volume's coming in and the market's reversing. And there we are on 5, and that's what I'm looking for. Ease of movement up, taking out that high, and that looks good. So the background of the weekly is informing my trade, and I'm looking on the daily to confirm that, to confirm what I'm seeing on the weekly, and to locate an entry opportunity. Everybody see that? Okay. Any questions on that chart? And then I think we're probably last chart here, coming into the end. All right. So remember I said I would take us through this weekly chart of Boeing here, or Bank America, I guess it is. No, it's Boeing. It's Boeing Aircraft, BA, in here, okay? This looks like the Google reaccumulation chart. Yeah, Google was like that about a month ago. It did exactly the same thing. And it had a nice spring, which we bought, by the way. Okay, so we're here, we're overbought. We see supply coming in at B. There's effort to go up, no result at C. And so let's take a look at this on the daily. So here's BA on the daily chart. And we can see certainly some supply potential there on 1. And coming down, we see volume expand to the downside. Not a good sign. A lot of volume still at 3, and it took it down. Buyers did step in, but we see supply there. I'm just going to highlight the areas of supply. 4 shows me supply. even 5, because it coming down on high volume, even though it closes firm, it shows that there's sellers in the market. There has to be to generate that kind of volume. At 6, there's effort to go up with that high volume in the area of 4 where we saw supply and no result. We still continue to kind of slide forward. We come up here on 7, decent volume, but we're not able to go through. 8 shows me lots of supply has come in. Okay, a lot of supply coming in. And then we draw our high across 1. We try to come up at 9. It looks like, in fact, we're going to make a shot going higher, but the very next bar is negative. And there's where we would short, on the very next bar. But this is all set up by the weekly chart showing us negativity and effort to go up. Then on the daily, seeing negativity in the background, no real strong buying coming in, a lot of selling coming in, and then the up thrust. And this bar right here is the place to go short. I think that's probably a live chart. I'm not sure. So that's it. Any questions on this or anything else before we wrap up? I apologize for doing 3 hours when we were really, it's twice the amount of time, but the questions were, I didn't want to miss anything or miss any of the questions. So of all your trade entries, what percentage of them are intra-bar and what percent are on the close of the bar? They're probably half and half, Jeff. I do a lot on the close. Some on the intra-bar if I, like if I were trading this market here and I saw this starting to slide underneath, I would short as it's going through. Or this bar here as it's coming down and I see this kind of volume, I might even short before it pushes down through. But I'm quick to get out if it doesn't. David Weiss also likes Renko charts. Yeah, because they filter out the noise. It seems that they would. I don't know. I don't really use the Renko charts, Bill. I'm not going to really comment on those. I can't really tell. You'd have to ask David about those. How much do I expect BA to fall? It's got a decent chance to go a little bit lower. Back certainly down to down to 120 would be the first line. Just somebody asked me, how do you do your targets? Here's one way that I would do it. So I would say, okay, I'm shorting in here. This is resistance that we broke through and is support, and there was a lot of buying that came in here. So this 120 area, a little above or a little below, would be a good first target for this market on this trade. Okay, I'd use support and resistance to kind of do that. When we short BA on daily, do we pull out to weekly to trail the move down? Not necessarily. No, not necessarily. Don't apologize, it was great. Good. Is bar 9 an exhaustion bar? Not sure what an exhaustion bar is. No, I wouldn't. It's just a market that tried to go up. Again, Linda, try to get away from labeling stuff and just look at, okay, it's a bar that we had sustained volume. Maybe we're breaking out. Let's see what happens. I wouldn't be buying this, and I wouldn't be selling it. I'd be watching it to see what goes on next. I notice that we're up above. So do we go up a little higher and then come back in and test in here and then go up? And then if that was the case, I'd be looking to buy here because this volume would be light and I'd have to reassess this. Or does on the next bar or two it does this? And that's what I would be looking for because the assessment is supply and we'd be looking to go short on this. Okay? Try to get your head out of that other stuff. On ES, do you use 3 times or just 2? Usually 3. For day trading ES, which time frames do you look at? I'm looking at tick charts. Usually the 3,000. Sometimes I'll go to the 20,000, 27,000, or the 15-minute, and then an hourly. Are you going to go to a lower time frame for your entry? No, Jim, right here. I do it on the bar that I'm watching. I don't play that. I don't do the other thing because then the eyes go to the small time frame and then that gets me lost, as it does with most people. Good, more than I expected. I'm glad that. Will you offer the Weiss Wave to this group at a discount? No, Tony, because I don't. It's not mine to offer. It's David's. What we will do though is this. I can't offer you David's thing. It's not mine to offer you. I would if I could. I'd be happy to give it to you for a discount, but it's just not mine. So I'm sorry for that. But boy, it's worth its weight. I'll tell you. As I said, as he printed on the cover of his book, it is hands down the best tool I've ever seen. All right, Helen's going to send you out as a way of a thank you to not for me going over time, but as a thank you, and you guys sitting through it, but as a thank you for coming into this. Helen's going to send out an email to everyone that will give you a 25% discount off of 4 of the training tutorials that we have. And they'd be a good, I notice that there's a lot of folks in here who are fairly novice. So, and not everyone, I know that there's a lot of experts in here too, and some professional fund managers that are in here. And I'm not trying to denigrate any of you guys. I know who you are, and I'm glad you're here. I'm happy you're here. You're welcome to be here. But I also notice that there's a lot of folks who are new. So because there's a lot of new folks, I wanted to, select a few things that you might find useful as sort of a next step up. If you're interested, you don't have to do this, obviously. Trading trends would be a nice addition here. We talked a lot about springs and upthrusts, but really didn't get into the details of them because I couldn't talk about trade setups themselves. And both of these videos they're an hour and a half or 2 hours on each of these trade setups, just the trade setup alone. So you get a sense of how I teach and how I explain things. So you can imagine, you can project that on just one trade or 2 trades. And then there's Chart Reading Mastery, which is really our great fundamental course. It runs for 8 solid weeks, and usually it runs 2 hours per session. So there's about 16 to 18 hours worth of very detailed stuff, talking about structure, how to construct trend lines, talking about a lot of bar by bar kinds of things, talking about how to create trade setups, what to look for. Somebody asked about checklists, and that gives you a good detail on how to create your own trade setups, which is what you ought to do. You ought to make this stuff your own, not take some trade setup that you read in a book and start applying it. That's not good. You can do that, but you got to do the research for it. So Chart Reading Mastery is people. I've had everybody from novices to extremely well-known fund managers, people that one guy trades $4 billion and says that this is a great course. So we always get good comments on it. And you can tell that I like to talk about this stuff, and I really do put my heart and soul in it. And so you get that with any of these tools here. On the website, there's plenty of description. I won't go into discussing them here, except for what I just did. You can read more about it because we're way over time. And just note that this is exclusive to this group. You can't transfer it to anybody else. And Helen will send out a code for this. I don't know what the code is. She doesn't tell me those things. But she'll send a code, and you can use that at checkout, and you'll automatically get the 25% discount. And that will be good for a week, I think next Saturday, February 1st at midnight Eastern Time. All right. So let's see. There's a few last comments before we end. Or questions, and let me do those. Lots of thank yous. That's great. I appreciate that. Will I offer the Weiss Wave? I answered that. 10-year notes at 750 ticks, and yeah, that's right, Jim. And that number. That's Chart Reading Mastery is great. Yes, it is. If will you resume the next chart reading mastery after you finish your book? Yes, I plan to do that. I plan to do that. And when does the book come out? Sometime this year. I'm still writing the last couple of chapters. What a pain this has been. When I use tick charts, the volume is even. That's right, Tony, and it will be, because if you think about it, it's based on the number of trades that are made, and most people trade one lots, and it's an even number of trades across the bar. A 3,000 tick chart has about 3,000 trades, and the next 3,000 tick bar has 3,000 trades. And if everybody's trading 1 and 2 lots, then it's going to be about the same amount of volume. That's why you need the Weiss wave to go with that. That's why I use the Weiss wave. How long will these be available if we sign up? I think it's a year or so, at least a year. Glad you liked the presentation, Edmund, and David, and Tong, and Tybone. Good to see you again. I can't wait to get back to Singapore. I'm waiting for these guys, for Gavin and Richard, to tell me we're going back. Glad you liked it, Charles. How many people signed up for this course? Quite a few, David, quite a few. Thank you, Sharif, I appreciate it. And Eric and Bill, reversal on the, it's in the Weiss wave, he does the bond. He sends out a setup chart, and it's listed in there. I forget what it is exactly. Glad you got something out of it, Brian. Appreciate that. And it's a lovely day in Sydney, Moby. Yeah, I'm sure it is. Yes, I'm sure it is. I'd like to get back there too. I loved Sydney. I loved Australia. What a place. Thank you, Tony. What will be the cost of the book? I have no idea. I think they were thinking around $50 or $60. It's going to be around 300 pages, 350 pages. Thanks, Sam. Appreciate it. And Lars, thank you. All right, everyone. Thank you very much. Look for Helen's email. Good trading to everybody. And thank you again for coming into this course. It's really, really, we really appreciate your coming to this. And I apologize for going longer, but I wanted to get the material through. So we covered an awful lot about reading bar charts and price and volume. So my strong, sincere recommendation is that you really practice this and practice and study your charts. And really, this is valuable stuff. Everybody that I know who works with the Wyckoff Wet method did so after trying to use indicators and other fancy kinds of stuff, and gave up on that, and then came into this and found it to be incredibly valuable, but also understood that they had to put an awful lot of effort into learning it and developing the skill set for it. It's not impossible. It is difficult to learn. There's no question about it. And it's especially difficult to apply real time because you're dealing with your head at the same time. Your mind, I mean, at the same time, which is never easy to do. But it's not impossible, certainly, and it is very doable. And you can see that if you just be patient and look for 3 or 4 points a day, some days you're going to do better, much better than that.